Hi everyone, welcome to revision session on book 3 where we will revise all the concepts related to the forwards, futures and options. And here we are going to discuss mainly, I'll just list out the topics first. So introduction to derivatives, then exchange and OTC market, central clearing, futures market, using futures for hedging, then pricing of financial forwards and futures, commodity forwards and futures, options markets, properties of stock options, trading strategies and exotic options. Okay, now in this session, what we will do, we will revise all these topics. But remember, because this is a revision session, we will ignore all the explanations given for those concepts or those topics. So we will focus only on the exam important area. There are a lot of concepts like the trading strategy where we have to only focus on what is given in that particular strategy and what is the use of that strategy. And there is an explanation. So we will avoid all the explanations so that our revision session is more useful for exam purpose than a general explanation session, right? So let's start with the introduction to derivatives. And now in introduction to derivatives, we discuss three primary concepts. So first is forwards, then we have futures, and then we have options. So we'll start with the basic concept of derivative. Just to summarize the basic concept of derivative is the security or the instrument which derives its value from the underlying. Now underlying can be the stock, it can be the metals, it can be the weather or so on. We have three types of derivative in this particular section because we are discussing the forward, future and options. But in FRM, we have also swaps, which is a derivative, forward rate agreement, which is a derivative. But here we are focusing on these three derivatives. So starting with the forwards. So in forwards, we know this is a very simple contract of buying or selling in future. So as we know. So first, this is the buying or selling. So whoever is buying in future is known as a long forward. Whoever is selling in future is the short forward. Long forward and short forward. Now long forward gains when price increases and loses when price decreases. On the other hand, short forward gains when price decreases and loses when price increases. So this is the opposite situation. If one party is long, another party is short. So remember, this is zero sum game. One party's gain is another party's loss. So this is what we need to remember. For all the calculations, we will only focus on one position, which is the long position. We will do all the calculations from the long's perspective, and short is just the opposite of long. Now here, assume a scenario. There is currently underlying, which is currently trading at $100, and the forwards price is say $110. We will also discuss forwards pricing, but in that section, the pricing section. Now at the time T1, if there are two possibilities. If say the forward price or the underlying price is at 130, this is your case 1. This is our case 1, and the case 2 is underlying price is 100. Now in this particular case, first of all, let's think about the long. How much long will win or gain? Simply here 20. Here he will lose 10, right? Now, what is the situation for short? So for short, the situation is just opposite. So he will lose 20 and gain 10, right? So this is how the forward works. Now in forward, we have this basic concept and then the payoff diagram. So you have to remember the payoff diagram. Payoff diagram looks like this. And this one is for long. This is your underlying price, and this one is for short. So as the price increases, long will gain, and as the price decreases, short will gain, right? So this is very simple. Please mute your mics, unless you want to ask your query, any query, okay? And make sure today you are asking query in English instead of Hindi. Okay, now here, this is a symmetric payoff. This particular structure is known as a symmetric payoff. Why? Because this is a linear payoff. There is no discontinuance here. Next, we have next discussion, which is the futures discussion. And what is futures? Futures is simply the standardized forward. Standardized forward. Why it is standardized? So that we can trade it on the exchange. Trade it on exchange. Fine. This is very simple, straightforward. Next is option. I'm just giving you the brief overview of first topic, then we will see if there are any further details in the topic. So in option, we know there are two types of option. So first is call option, then we have put option. And we also know there are two varieties of option. One is European option, then we have American option. Always remember, if we are not specifically mentioning the type of option, even in the book or in discussion, we are talking about the European option, and American option will be specified specifically even in the exam. If the option is American option, GAP will specifically mention that this is the American option. If the option is European option, GAP may or may not provide the specific information. If nothing is provided, assume European. If American is said, obviously we will go with the American option. Now here, what is the difference between the European option and American option? The difference is very simple. So European option can be exercised only at the expiration date, and American option can be exercised before the expiration date. Should we exercise the option? We will discuss this in the properties of option chapter, right? Now here, mainly if we focus on the European option first, and whenever the discussion comes for the American option, we will focus on the American option. Here we have the call option and the put option. What is the call option? Call option is simply the upside betting. Upside betting, and put option is simply downside betting. So we have underlying price. If the underlying price increases, so this is the upside gain. If the underlying price decreases, this is a downside gain. So upside gain is for the call and downside gain is for the put. Here for the option, we have few properties. Properties are like, or the specification of option, strike price, time to maturity, or simply the expiration date here. Then the underlying. What is the underlying here and what is the underlying price? Okay. And based on this, we will definitely be able to decide what is the ultimately the payoff or profit of the option. Let's start with the assumption or example. Say the strike price of this particular option, the call option, is 100. Then time to maturity is 1 year, doesn't matter for our case. And the underlying price currently trading at say 90. Now at the time of maturity, there are again two possibilities. First, case 1. In case 1, we have say 120, and in case 2, we have 90. Now the basic property or basic nature of the option is if you win, that is if the underlying price is above 100, then you get payoff. So if the underlying price is above 100, you get payoff. And who is you? Long position holder. Now here the payoff is 20 and here the payoff is 0. Now this is the nature of option. If you win, if the underlying price is above certain level, which is say 100 in this particular case, because 100 is a strike price, so the long position holder will gain. And if the price is below the strike price, then the underlying price is below the strike price, then long have nothing to lose. And for this reason, because this particular option provides some kind of security or the position where you have only upside gain and no downside gain for the long position holder, that's why you have to pay premium. And this premium is denoted as C. And when you see this, the simple difference between the underlying price and the strike price for the call option, this is your payoff. Let's assume the premium is equal to 5. If we assume the premium is equal to 5, then we can also calculate. I'll just mention this here. So 20. So this is for 120 and for 90, 20 and 0. And this is your premium paid. Premium is always paid by the long to short. Always remember this. Always paid by long to short. Minus 5. In this particular case, what is the profit? Profit is 15 and minus 5. So long has fixed loss and unlimited possibility of profit in case of call option. Now here in call option, we have two positions. Long, the person who purchases the call, short, the person who sells the call, the person who purchases the call and person who sells the call. So whatever is the profit or payoff for the long is the opposite for the short. So here in our case, we assume the 20 is payoff, 20 payoff and 15 profit. Okay. So payoff and profit. So automatically for short, this will be loss of 20, that is payoff of 20, negative payoff of 20 and loss of 15. Very simple. Why loss of 15? Because he earned premium, because long paid premium to short. And in second case, this is loss for long and gain or profit for short position holder. So simple. Call is upside betting. You get the payoff or the profit only if the underlying price is above the strike price. If this happens, long will gain. Who will pay to the long? Short. Simple. So always remember, this is going to be same for call and put. So long will gain if the underlying price goes beyond the strike price. But remember, this will be paid by the short. And same will happen for the put option also. But the direction will be opposite. In the put options case, this is downside betting. And in downside betting, if the underlying price is below, and when to check it? At the expiration date. If the underlying price is below this strike price, put option holder will get the payoff or the profit. Again, we will take the same example. Strike price is equal to 100. Time to maturity doesn't matter for us in this particular case, say 1 year. Then premium P0 is say 5, and then underlying price. Currently it's 90. And again, we will take the two cases. So first, case 1, underlying price at the maturity is 120. Underlying price at the maturity is 90. Now for long, payoff is equal to 0. For long, payoff is equal to 10 in this particular case. Okay. So why? Because the strike price is 100 and this is a put option. This is a downside betting. The long holder will gain only if the underlying price is below the strike price. And if we have this situation, the 90, and the difference between the 100 and 90 is 10. Simple. And what will be the profit in this particular case? Obviously -5 loss for long position holder and 5 as a profit for long position holder. Then for the short position holder, payoff. Remember, whatever is gained by the long is paid by the short. So in case 1, the 0 payoff, and case 2, this is -10 payoff. When it comes to profit, this is profit for short and this is loss of 5 for short. Very simple. Okay. Now this will help you in solving all the questions in examination. If we talk in the proper format or the technical definition of the call or the put. So call is right to buy and put is right to sell. Okay, simple. But for exam, this right to buy and right to sell is not going to help you a lot. So just remember what is right to buy and right to sell. So call is simply right to buy, which is bought by long and sold by short. Then put is right to sell, again sold by short, bought by long. Okay, now here you have to always remember the payoff diagrams and the profit diagram. So first, if this is the strike price, this is A, this is B, and GAP tests this in examination. So you have to remember the payoff and profit diagram for call option, put option, long call option, short call option, long put option, short put option. Now tell me, A, is the payoff or profit, and for whom? A, payoff or profit, and for whom?
A is profit for long.
A is
Profit for long.
profit for long. What? Put or call?
Call.
Call. C. Profit or payoff, and for long call, long put, short call, short put. Yes?
150 ना अरे వాళ్ళ దగ్గర ఉన్న
Profit for
Short.
short. Short what?
Short option.
Call or put?
Put.
Any objections?
Profit for long put.
Correct. Profit for long put. Always remember, this unlimited payoff, unlimited positive payoff can only happen for long position holder. Long position holder. There is no possibility of unlimited payoff or unlimited profit happening for short position holder. Now D. And that's the reason GAP tests this in examination, because students make mistake in this.
Profit for short put.
Short put is fine, but this is not profit, loss. Loss for short put. B.
Loss for long call.
Loss for long call. Okay. So this is fine. So you have to simply check this. Okay. So
Short call.
short call. Just a second. Loss for short call. Now I have to just focus here. So this is the position for call option holder. As the underlying price is increasing, the payoff is generating. Okay, so this is possible only for call option. Now if the payoff is positive, this is for long call option. If the payoff, I'm saying payoff, but again, payoff and profit will work in the same manner. If the profit is in the positive direction, then this is for the long call option holder. And if this is in the negative direction, that is in the loss side, like here, then this is for the short position holder, and for call. Then opposite is true for put option. So as the price decreases, as the underlying price decreases, if there is loss or if there is gain, then this is the position of put option holder, put option. And if there is a gain, then this is for the long put. If there is a loss, then this is for the short put. Simple. Short put, long put. Very simple. If we consider the profit diagram, then payoff diagram and profit diagram will look like this. This is the payoff diagram, and this is profit diagram. Okay. And in exam, you have to also guess if this is the payoff or profit. Simple. Now, here we can clearly see the payoff is discontinuous or the non-linear payoff. So option pays a non-linear payoff. Option has non-linear or discontinuous payoff or profit. Okay. Okay. So this is about the call, put, in option, forwards and futures. Now let's see the notes. First, we have this, what is financial instrument, not at all important for your exam, derivatives, basic definition, never get tested in examination, the underlying is something from which the derivative derives value. Then we have other miscellaneous discussion, which will get elaborated in the further topics, so we will discuss it there only. Then forwards and futures discussion we already discussed. Then there is a long forward, we discussed this, short forward we discussed. Then the inception date and the settlement date. Inception date, the date on which the contract is formed, the forward contract is entered into. And the settlement date is the date on which the contract is settled, or simply the maturity date of the contract. Then there are the illustrations. Just check these illustrations. We already discussed the illustrations. So anyway, you will be able to handle the illustrations. Always remember, for long, this is the general confusion, like students take slightly more time in this particular area. So remember, for long forward, gain is when the underlying price increases. For the short forward or the futures, gain is when the underlying prices decreases. So we can simply say the long forward is bullish on the market, short forward is bullish on the bearish on the market. Same here in case of the call. So call holder, the call holder means the long call, long call position holder is bullish on the market. Long put option holder is what? Bullish or bearish on the market? Bearish on the market. Short call, bullish or bearish on the market? Bearish or bullish? Bearish on the market. Short put? Bullish. Fine. Next. Payoffs. This is the payoff diagram. Just check it once. This is the long forward and short forward. Then we have the call option, options, call option, put option, properties of option. We have strike price, underlying expiration date, premium. Then this is the illustration. We already discussed the illustration, so we don't need to discuss it here. Then there's a payoff versus profit difference. We already discussed the payoff versus profit. So simply the profit is payoff minus premium paid. Okay, now see here. Payoff formula is generally written as, you don't need to use this in an examination, this is just for the information. So S minus X 0, this is for call, and max X minus S 0, this is for put option. Okay, then payoff and profit diagrams for call option. Always remember the flow. Okay, so it is starting like this and then it is spreading as the underlying price increases. Then payoff and profit diagram for put option. Again, focus on the diagram. Then we have this basic discussion, the over the counter and the exchange market. Over the counter is simply the over the counter exchange market, or the exchange traded securities, or the market is simply the forwards, the futures and the options which are traded in the exchange are the exchange traded. Simple. And the over the counter is based on mutual discussion. So two parties will sit together and they will decide. So generally when we say two parties, it is not a one-to-one party. It is generally the traders who are involved in this particular or the dealers who are the over the counter markets, or the over the counter dealers. Okay, those who form the over the counter market. So otherwise this is a basic discussion. You don't need to remember all these, like the what is the size of the exchange market versus the size of the forward futures market. This is not at all testable in your examination. GAP never focuses on the these details, okay, which are not relevant for the examination. Okay, then hedgers versus speculators versus arbitrageurs. Hedgers, they have some existing position, they want to secure their risk, they want to reduce their exposure. So this is the hedging. Speculation, they don't have any position, they want to just speculate on the market and want some gain from the favorable movement in the market. It can be the bullish or the bearish. So speculators don't have any existing position. arbitragers who wants to exploit the inconsistencies in the market. So very simple definition. Then we have next discussion, which is the exchange and OTC market. So again, this is very theoretical in the plain discussion. So first of all, we have the exchange. Exchange is the platform where the parties can trade the instrument or the securities. These are heavily regulated. Only standardized derivatives can be traded in the exchange. Then we have the clearing process and central counterparties. What is the clearing process? Simply in exchange, when the two parties trade with each other, one party takes the long position, other party takes the short position. So exchange's responsibility is only to facilitate the trade, only to give them a market to facilitate the trade. Once the trade is executed, for all the other purposes, it will be transferred to the clearing process or the CCP, central counterparty, and the clearing process will handle all the other work related to that particular trade, like asking for the margin, paying the margin, maintaining their balances, maintaining their position, dealing with the settlement. Once the trade executed, from the execution till the settlement, all the works are handled by the clearing process or the central counterparties. This is what you need to remember. Now, what are the responsibilities of the counterparty? Handling clearing process, one, and second, reducing the credit risk. Okay. Then CCPs are extremely vulnerable to credit risk, and the steps they use to mitigate this particular risk is netting, margin requirement, and default fund contribution. So wherever the topic comes, we will discuss this. First, the netting. What is the netting? They will net the position. They will merge the position. So if I am the long and short both for the same CCP, remember, it can be with a different party, but we will never know because this is the exchange. In exchange, we will never know who is the counterparty for us. So for us, the counterparty is CCP only. So if I have the long position and the short position, or in different style, if I have the receivable of say $50, receivable of $50, so plus $50 from exchange and payable to CCP $100. If we just consider this, so without netting, CCP have total $100 exposure from my side. If I default, CCP will lose $100. CCP will net this position, and whatever is left is minus 50, and this is the final position, netted position, and now the exposure for the CCP is reduced, and this is how the CCP reduces their exposure. Then we have the margin requirement. In margin requirement, we have three types of margin. So initial margin, maintenance margin, the variation margin. So what is initial margin? The margin which was required to deposited at the time of entering into the contract is the initial margin. Maintenance margin, the margin which you need to maintain to stay in the position, is known as the maintenance margin. Variation margin, the margin you need to pay to maintain your position if the margin balance goes below the maintenance margin, is the variation margin. If I have to just show it here, if this is your margin requirement, if say this is the $10,000 your margin requirement, say 7,500 is the maintenance margin requirement. So this is initial margin requirement, this is maintenance margin requirement. So if my margin balance goes below this particular maintenance margin, then I have to replenish the margin, and this replenishment can be up to the maintenance margin or the initial margin, depending on what type of security or what type of position we are dealing with. So this is the variation margin. Variation margin is nothing but the amount we are paying, okay, on the margin call. Very simple. Fine. Then there is a default fund contribution. We have the margin discussion again in this section, so we will discuss it in the detail in just like few minutes. Now the default fund contribution. So default fund contribution works in a very simple manner. So at the time of becoming a member of a CCP, you have to submit or you have to deposit some funds. So this is first your initial contribution, and this is from the members. Okay, so if you are clearing through the member, then this is not applicable for you. So member will collect margin from your side. So this margin will be available with the CCP. In case of default, there is a process which will be handled by the CCP, and how these losses will be absorbed is given here. Now, first of all, the sequence, how the losses coming from the defaulting member are absorbed. The sequence is the initial margin by defaulting member, then default fund contribution, the default fund contribution or the fund deposited at the time of becoming member. Okay, so if someone became a member 10 years before, so he must have deposited some funds, and that fund is known as the default fund contribution. So then default fund contribution will be utilized again from the defaulting member, and if this is again insufficient to absorb the losses, then the default fund contribution of the surviving members will be utilized. GAAP might twist here and say the initial margin of surviving member. Remember, the initial margin is never touched for the surviving member in case of default. Okay. Then the margin requirement, here in margin requirement, you can ignore this particular part, the initial margin. This is the exam important note. This is the margin requirement as per GAAP. Now what GAAP did here, GAAP provided margin requirements calculation, the illustration of the margin requirement, which is totally different from whatever is the treatment GAAP giving in the examination. Okay. So if you just take the same chapter, there is a question on this particular margin requirement using the same illustration, and GAAP solved that question in very different manner compared to whatever is given in the text. So this was given because GAAP used this illustration, but this is not important for your exam. Now, what is important for your exam? This. Initial margin, maintenance margin. So first of all, if this is for the normal forwards and futures. This is for the normal forwards and futures. Let's assume the initial margin is equal to $10,000. Maintenance margin is equal to $7,500. Contract was entered into in say $1,000 and 10 such contracts. $100 such contracts. So total value is simply 1 lakh. Okay. Now see here. This is the price F0. On the day one, price goes to 950. Now this will be a loss or gain, depends on the position. Let's assume the long position, and same will be applicable for the short position, but in the reverse order. Now here we have the first loss. This is really big loss. Okay. So let's say 995. And the total loss is $5,000. Now this $5,000 will be charged in the margin balance account. Initial margin was 10,000. Now the loss charge is 5,000. Total balance, margin balance account is, or margin account balance is 5,000. This is 10,000 minus 5,000, and now there will be margin call. Okay, and margin call is for, remember, you have to refill it to initial margin. So this margin call will be for 5,000. Okay, because current balance is 5,000. This is below your maintenance margin. 7,500 is a maintenance margin. This is below the maintenance margin. Once it goes below the maintenance margin, you have to replenish it to the initial margin, and initial margin is 10,000. So to get the 10,000 margin account balance, you have to pay 5,000. Simple. This will be pay, and same amount will be received by short. Okay. Now if we assume the shorts position, then same thing. We can take the example of say $1005. Say this is the price on day one. Okay, day 0, this is the inception date. On day 1, this is the price, and given this price, now you have different calculations for the short position. So you have to, here the particular loss will be charged in the shorts position, shorts initial margin balance, and then based on that you will calculate the initial margin, maintenance margin, and then the variation margin. Okay, so initial margin and maintenance margin will be provided to you. You have to only calculate the variation margin, but using the initial margin, the maintenance margin. Fine. Then next, and this is elaborated or provided in this particular illustration. Then we have the margin account requirement on options on stock. Now remember, this is the very critical area and new area introduced in the 2020. So first of all, this is as per CBOE. Okay, and this is how the margin is calculated in CBOE. In my opinion, GAF will provide you this information like how to calculate the margin requirement. Okay, now remember, in case of the forwards and the futures, or specifically in the case of the futures, the margin requirement is applicable for both long and short. But here, in case of the option, margin requirement is only applicable for the short position holder, not for the long position holder. Because once the contract is entered into, once you have the option position, if you are in the long, you don't have anything to lose. If you have, say, if the contract is exercised, if the call is exercised, then you will gain. If the call is lapsed, then you have nothing to lose. You have zero payoff. And for this reason, the margin requirement is not applicable for the long position holder, irrespective of this is the call or put. Margin requirements are only applicable for the short position holder for both call and the put. And margins are calculated as greater of A and B. If you can remember this. But again, as I said, I don't think this particular portion will get tested directly in examination, because again, this is a very fact-based information. Now, A is calculated as 100% of value of the option plus 20% of underlying. Okay. 100% of value of option plus 20% of underlying, and it is adjusted for the out of the money difference. If the option is out of the money, then this is adjusted for out of the money difference. B is calculated, this is for short call. B is calculated as 100% of value of the option plus 10% of the strike price. This is how you calculate the B. Now you have A and B, whatever is the greater, whatever is the higher, you have to take that as a margin requirement. Next, short put option. Here we have similar treatment for A, 100% of value of the option plus 20% of the underlying price. But again here we will adjust it for the out of the money position. If again, this is applicable only if the option is out of the money. If option is in the money, then you don't have to do any adjustments. Okay, so simple. Out of the money, for example, how to make this adjustment? I'll give you a very short example. So consider currently the underlying is at 100, and then you have option premium is equal to say 10, as S0 is trading at 100, and strike price is say 95. We are assuming put here. Now how to calculate A? 100% of premium paid, value of option, plus 20% of underlying price, 20, and this is adjusted for difference of out of the money. This is the put option. We have to take it to the out of the money, say 105. What is the out of the money difference? Underlying, the difference between the underlying and the strike price. Right now this is the out of the money, and the difference is of 5. So you will reduce 5 from here, and then 10 plus 20, 30, minus 5, 25. So this is your margin requirement in A. Then you will calculate it for B. For B, this is 100. For value of the, this B is calculated as 100% of value of the option, which is 10, then plus 10% of strike price. Strike price is, I made change here. I should have made change here. Okay. Now see here, just do the A's calculation. Now for the B, S0 is equal to 100% of the value of the option. B is equal to 100% of the value of the option, which is 10 plus 10% of the strike price. So strike.
This on the web for is equal to 100%. Check it out.
10, 100% of the option value plus 10% of strike price, 10. Okay, so here we have 20, and again let's do the calculation for this A also. So 10 plus 20% of the underlying, so 20% of the underlying is approximately 21, plus minus out of the money difference, this is minus 5. Okay, so I hope you understand this. If you have any confusion, you can ask in this particular area, and you have illustration also, so you can check this illustration for the calculation.
Do we have to keep these formulas in mind when we are attempting the question?
I don't think so.
This needs memorization.
No. In my opinion, this is very fact-based information. This is not universal. This is only applicable for CBOE. And that's why I think like you won't get tested directly on this area. And again, this is a margin calculation question. So if you get a question on margin, and here remember what will be the problem. So you have to maintain this much margin. So say today you are entering into this option, you have to do all the calculations by applying these rules, and you will get the margin requirement. And then again on next day, say day 1, you have to again do all these calculations and apply margin rules to calculate the margin. And based on that, you will decide to pay the margin or receive the margin, and like that. Okay, so that problem is there. And for this reason, I don't think like this will become very complicated if this gets asked in the examination. So I don't think like GAF will ask this question in the exam. And if this question is asked in the exam, then GAF will provide you the specific information like this is how you have to calculate. And then GAF may want to see like, okay, how you treat this particular setup like this. Okay. But again, this is easy to remember, not that difficult. If you want to, you can. Okay, then short sell. Now here for the short sell, we all know what is short sell. Short sell is you are borrowing and then you are selling it. Now in case of the short sell, whatever you are selling, the sale proceeds from the short sell will be considered as a margin by the CCP, and then there will be extra margin to account for the adjustment of the losses. Now here the margin requirement calculation will go directly to the illustration only. So initial margin requirement is 150% of the short sale, and maintenance margin is 100% here. Just a second. Maintenance margin is 125%. Okay. Now here this 150% of initial margin is coming like this. So assume you make a short sell of $100 and your margin requirement is of 150 here in this case, because the initial margin requirement is 150%. Now for this 150, you sold this $100 with the help of broker only. So broker will consider this 100 as a initial margin. So this is coming from your sale proceeds, and from your pocket you have to deposit $50, which will be used in case you are generating losses. Okay, from own pocket. And this is how you deposit the $150 margin or 150% margin. And out of this, you have to maintain 125%. Now here we are starting with the illustration, and here in the illustration, the underlying price stock is worth $100. On the next day, stock's price is 110. Remember, for the short sale is bearish on the market. He's expecting that market price will fall. If the market price increases, then he will generate losses. So here on the day 1, stock price increases. If the stock price increases to $110, he will generate some loss. Now, the maintenance margin requirement is 125. This is how you calculate it. 125% of 110. This is 13750 multiplying by 100 stocks. Here we are assuming this. Okay. So 100 stocks, 150% margin. So $150 per stock, and multiply by 100, you have the 15,000 margin requirement. Initial margin requirement, and 125% is the maintenance margin requirement. Now current margin balance account is 15,000. So no variation margin requirement is there. Then stock price is 120. What you have to maintain 125%. 120 multiplied by 100. So you have 15,000 now. Again, your margin balance requirement is the 15,000 only. This is the margin balance account requirement, and this is your margin balance. Now here we have 130 stock price as per requirement. So maintenance margin requirement is 125% of this, like 130 multiplied by 100. So your margin requirement is 16,250, but your balance is only 15,000. So you have to pay the variation margin. You will get the margin call of 1250. Now here you have to remember, you have to replenish the margin only up to the maintenance margin requirement. Okay, so this is a key point here. You don't need to put it to initial margin. Okay, so you don't have to reimburse till the initial margin, just pay for the maintenance margin. You have to maintain the margin now. Then there is a concept of buying on margin. In buying on margin, it is simple. You have few of your securities with the broker. You will simply say, I want to buy to the broker. You will say, I want to buy on the margin. So, okay, broker will say, okay, 50% you deposit, 50% I will pay. I will pay you as in, I will provide funds for your purchase. Okay, now if you want to purchase stocks worth say 20,000, if the 50% is the requirement, then 50% you will pay from your own pocket, 50% are lent to you by the broker. So 50% initial margin requirement is there.
I have a question in shorts.
Yeah.
Now, a very recent example of parameter. I think the discussion will go way forward. But my question is, if an institute or institution puts a short call on such big accounts, do they have to fulfill 150% of the requirement?
It depends.
On the short side.
It depends. Again, this is the example, purely example of 150% and 125%. Now this is charged by the broker. So this depends on the terms of broker and the client. Okay, so for exam purpose, we have to focus on whatever is given. This will also change based on the volatility of the market. If the market is highly volatile, then this can go up to 200%. Okay, so this will depend on the market because it's a broker thing. This is not a regulation thing. Okay. Yeah. Next, buying on margin. 50% initial margin requirement is there, 25% maintenance margin requirement is there. Now see, if you purchase stock worth 20,000, so 50% initial margin requirement is there, so you will pay 10,000. Broker will lend you 10,000, and this is how you buy it. This 10,000 is your initial margin. Okay, so this 10,000 will be considered as your initial margin, and this will be considered as your loan. Very simple. Okay, and then there are the margin requirements. So 50% of the initial margin and 50% is the initial margin, 25% is the maintenance margin. So we'll start with the illustration here. Again, these things can be better understood by the illustration itself. Okay, now here trader needs to pay 10,000 as we discussed. The remaining 10,000 is loan from the broker. And the steps, the purchase here is trader wants to purchase 100 shares at USD 200. So total 20,000. First, day one, stock price goes to 190. Remember, this is proper buy. Even if this is on the margin buying scenario, but this is a proper buy. So trader will lose if the price declines. Simple. Stock price is 190. Margin account balance after adjustment for the losses is 9,000. How? So 1,000 loss, that is 10 multiplied by 100. 1,000 loss, your initial margin was 10,000. 9,000 is 10,000 minus 1,000. So 10,000 initial margin minus 1,000. Maintenance margin requirement is 25% of your this amount. Okay, so what is the underlying price right now? This, remember, this is 25% of current price. 190 multiplied by 100. This is 19,000, and you have to maintain 25% of this. Then day 2, price goes below to 175. After adjustment, your margin balance account is 7,500, and your maintenance margin requirement is 17,500. That is 175 multiplied by 100, 17,500 multiplied by 25%. So this is your maintenance requirement, 4,375. This is your balance, 7,500. No need to pay any margin. Day 4, this is the balance. Again, you will charge losses here, and this is the requirement. Balance, requirement. Still, you are everything is under control. Then underlying price goes up to 115. In this particular case, after adjusting for the losses, this is 1500. Your margin balance account is 1500, but your requirement is 2875. Now you have to pay the margin. There will be a margin call, and remember, this margin call is only up to maintenance margin and not till the initial margin. and whatever you pay will get adjusted in the loan. Is adjusted in loan. Always remember this. Okay. And GAP might ask you this question, like what will be the loan balance after the margin payment. So you have to tell this particular part. Okay, so you have to solve like this. So 10,000 was loan initially. 1375 is the margin payment. 8625 is the loan balance account. Fine. Now see here again, just an alternate explanation. So we have this 115 multiplied by 100 is equal to 11500. Okay. So stock worth 11,500. Now, as I said, this will be funded by two things. One, your own margin plus the borrowing from broker. Now here 11,500 is funded like your margin balance requirement is fulfilled now. You paid the margin. So your margin account is 2875 and loan balance is 8625. If you total it, it will be 11,500 like this. Okay, so this will get automatically adjusted. Then we have the over-the-counter markets. So over-the-counter market is, again, this is a theoretical discussion, very basic. So major disadvantage is the credit risk when it is cleared bilaterally. Now we have upcoming the changed scenario where OTC trades can also get cleared through CCP, which we will discuss here only. Like which type of derivative, the type of derivative which can be traded on the or which are traded on the OTC but cleared via CCP. So here, if it is cleared bilaterally, means mutually, 1-to-1, then there is a credit risk. Then these are the points you need to remember. So probability of counterparty defaulting. This is very important. As the life of derivative increases, it will increase the probability of counterparty default. Remember this. And from the market variables perspective, the market variables that determines the value of derivative are likely to move more during the life of derivative as the life of derivative increases. Obviously, this is very obvious. If you have derivative which is maturing in 3 years, obviously there is a higher probability of market variable like the volatility, underlying price and everything, and also the other variables which might move higher if you just compare it with the derivative which is expiring just 1 month. If you compare this expiring in 1 month and expiring in 3 years, obviously market variables impact will be higher on the derivative which is maturing in longer duration. Then risk mitigation techniques. So bilateral netting in the OTC market, then collateral and special purpose vehicle. So again, this is a very general discussion. If you get any question, so question will mostly on the margin requirements. Okay, so margin requirement is very important area here. Bilateral netting in OTC market. So first of all, if we are trading, okay, so I have the long position, you have the short position in one derivative, and then there is one more derivative where again we have the similar positions, but in one position I have receivable, in one position I have payable. Again, receivable 150, payable 50. So we will net it. So this is a bilateral netting. Okay, so this is not with the help of CCP, this is a bilateral only. Then collateral. So we will ask for the collateral. Now remember, in collateral the problem is when the trading is bilateral, the collateral handling is very problematic. If I pay you collateral, you pay me collateral, this is null and void situation, right? So we will appoint someone to handle our collaterals. We will pay collateral to that particular person or the party, and he will manage our collaterals. Okay, so that's the collateral management. Then we have the special purpose vehicle. So SPVs, special purpose vehicles, can be created. Generally, these are created by the entities who wants to trade into the derivatives, and they don't want that risk of derivatives, the credit losses and everything. So they will create one particular entity. We'll call this as a special purpose vehicle, and they will trade through that particular derivative entity. Okay. So here, in the context of the forward futures market, the special purpose vehicle is like the derivative product company. Okay. So like this. Now here, This is again the example of the mortgage and credit loans and everything. So you can also relate the special purpose vehicle with the discussion of the MBS. In MBS also, we discuss the special purpose vehicle. So again, the special purpose vehicle by name itself, this is special purpose, a special purpose entity designed for this special purpose. It can be for the derivative trade, it can be for the securitization purposes and everything. Again, the derivative product company is the same as the SPV, but again, the purpose is to trade in the derivative. Then credit default swap, CDS. CDS is simply like the insurance. So you will get the credit default swap. If the party defaults, you will get the payoff. Simple kind of insurance. Next, central clearing. This is again very theoretical discussion. Central clearing, I assume we already discussed the clearing part. Okay. And here, I highlighted this, but trust me, this is not at all important. These are very basic things. But the only important part here is like the CCPs. Now, the CCPs can be attached to OTC. So OTC trades can be cleared through CCP. So there is a mechanism. And here, the CCPs of OTC will work like a CCPs of exchange in the exactly same manner. So here we have the CCPs for the OTC examples. You can read this, not at all important for your exam. The operations of CCP in the OTC derivative market. Again, these are very basic discussions. So fact-based information is given here, not at all important. Okay, so CCPs will charge per trade fees. Again, the generic discussion, initial and variation margin. As I said, all the things which are applicable for the CCPs of exchange will be applicable here. So initial margin, variation margin, default fund contribution, everything will be applicable here also. Regulations of OTC derivative market. This is very important and highly testable area. Now this is the outcome of G20 summit. 3 major regulations affecting the OTC derivative market. First of all, now this is applicable only for the OTC. Okay, so all the standardized OTCs should be cleared through CCP. First, you have to remember this, including plain vanilla interest rate swaps and credit default swaps on indices only. Remember this. Second requirement is standardized OTC derivatives traded on the electronic platform, or should be traded on the electronic platform to improve the price transparency. Now see, difference, all and standardized. So all the derivatives, all the standardized derivatives should be cleared through CCP, and here the requirement is all this, like the standardized derivative. If the derivative is standardized, it should be traded via electronic platform. Then, if it is traded through the electronic platform, the prices at which the products are traded should be readily available to all the market participants. The platforms are called swap execution facilities, SEFs, in US. Not important. Requirement, all the trades in OTC. Just a second. There is a difference. Okay. Just ignore this and now see. All the trades in OTC market reported to central trade repository. And this is a difference. I by mistake highlighted here. This is not the point to highlight. Now see, standardized derivatives should be traded or cleared through CCP. 1. Standardized OTC derivatives should be traded on the electronic platform. So if the derivative is standardized, then these two is applicable. But for all the derivatives cleared or all the trades cleared through OTC market, these should be reported to central repository. So here we don't have any standardization requirement. Simple. Now, this is again important. Regulation A and B is only applicable for the transaction between two financial institutions or between a financial institution and non-financial entity deemed systematically important. 1. This excludes dealers from trading on electronic platform and using CCP when trading with the non-financial end users. So if the trade is dealer to dealer trade or like that, then remember, they don't have any compulsion. So regulation A and B is only applicable in 2 situations. What are these situations? This is again the testable area. This is what I think. Okay, this is very new or recent changes, and there were only 2 exams on after these changes were made by the CAP. So I don't have enough information to give you. But again, everything I'm telling from my gut feeling. I know how GAP tests the test in the examination. So based on that, so two financial institutions or between financial institution, non-financial entity, but systematically important. Okay, so important entities should be regulated by regulation A and B, and not the other, like the dealers who trade at very low volume. Then standardized versus non-standardized transactions. So first of all, for the OTC CCP to be cleared, to clear a product, following conditions must be satisfied. Now, what are these conditions? Legal and electronic terms of the product must be standard within the market. So there should be a market standardization for the legal and economic terms. There must be generally accepted model for the valuation of the product or the valuing the product. So that CCP should be able to calculate the variation margin. This is again very like common sense thing. If there is no standard model available for the valuation, for example, we know we have the standard model applicable for the valuation of swap. Swap is the OTC, generally the OTC traded derivative. So if we have available model, then CCP will be able to calculate the variation margin. And based on that, if this is the condition, then these are the requirements for any trade to get cleared through CCP. Product must be traded actively, very important, so that the price discovery should be there, or even if there is a margin requirement calculation, or they need data, right, for the margin requirement calculations and everything. So product should be traded regularly or actively. Extensive historical data on the price to enable the initial requirement. Okay, so to calculate the initial requirement, historical data should be there so that they can calculate the volatility. Remember, initial margin, maintenance margin depends on the market volatility, and historical data should be available for the calculation of all the market volatilities and everything. Now, third condition is very important because for less actively traded products, it might be difficult to unwind the positions, and this will create a problem for CCP, right? So if one party wants to exit, CCP don't have any counterparty, then CCP will face the problem. Then again, we have the G20 summit and everything. Now here, this statement is important. So initial margin, whatever you are calculating for the initial margin, okay, whatever is your value for the initial margin. So initial margin should cover the greatest decrease in the value of contract estimated to occur over 10 days with 99% confidence level in the stressed market condition. So you have to calculate this, as in like in theoretical standpoint, you will get in the theory only, but this is what you need to remember. Okay. Then netting versus bilaterally cleared trades. So bilaterally cleared, one-to-one cleared, netting is this. Okay, so these are the examples. This type of thing cannot be tested in examination. Okay, so simple. GAP will provide you like there is a receivable and payable. One important note. In netting, this is this mistake committed by student most of the time. You have payable $10,000. Okay, so you are losing $10,000. You have derivative position and you are losing $10,000 currently in this position. Question: what is your exposure? Credit exposure. What is the value of your credit exposure? Anyone? This much information is more than enough to answer this question. What is the value of your exposure, or credit exposure specifically? Now, you also have receivable of $5,000. Now tell me, what is the value of credit exposure?
5,000.
Anyone? Like any other who wants to counter? initially when I said you have only payable amount of $10,000, then at that time the exposure was 0 because the payable exposure comes when you have the receivable. The credit exposure means the counterparty will default and you will lose the money. If you have payable, how will you lose the money if the counterparty defaults? So there is no exposure, zero exposure. However, if you have a receivable of say 5,000, in this particular case, this $5,000 receivable is your exposure. Okay, so this is without netting. If you again do the netting, then these two values will be netted, assuming this is cleared by a same CCP or this is to the same party. In this particular case, after netting, what is the exposure? 0, correct. Okay, because at the end you have 5,000 payable, and this 5,000 payable means again the 0 exposure. So again the same thing is explained here. Then the advantages and disadvantages of using CCPs. First is the easier exit for the market participants, because if you are in the bilateral trade and if you say I want to close my position, and if the counterparty rejects, then you won't be able to exit the market position. So here, if you are with the CCP, you have to simply, if you have the long position in derivative, then you have to simply take the short position on the same date, same underlying and everything same, and automatically your position will be squared off, and this is the easier exit. Then lower credit risk, because CCP will handle all the clearing process, will ask for the margin and everything. So lower credit risk. Interoperability, currently not happening. Interoperability means there are two CCPs. I have receivable from one CCP, payable from one CCP. I have paid funds to each CCP. So my initial margin, maintenance margin should get netted between the CCP. So this is the interoperability, but this is not currently happening. This is like they are planning, but let's see when it happens. Interoperability is possible if the trades are done via CCPs. But again, here we are assuming multiple CCPs. Loss mutualization, simple. Better operation management, simple. Improved liquidity, simple. Standardized document, simple. Next, disadvantages of CCP. First, moral hazard, then adverse selection, pro-cyclicality. Moral hazard. What is moral hazard? Simple. If I know the CCP will take care of the credit risk, I will take higher risk. 1. Adverse selection. I know CCP have some regulations, and this regulation costs me a lot because I have to pay the initial margin. It will cost me loss of opportunity, right? So opportunity cost is there by paying funds. Otherwise, I would have deposited it in the market. So what I will do, if I have say 10 trades, out of which 6 are very risky, 4 are safe. So I will only give these 6 risky trades to CCP, and I will keep 4 with me. So this is the adverse selection. So automatically CCP will gather all the risky trades. Automatically, this will happen. So this is the thing. This is the disadvantage of CCP. Pro-cyclicality. Pro-cyclicality is again the problem with CCP, because when the markets are adverse, there is a higher volatility. In higher volatility, CCP will ask for higher margins. To pay for higher margins, traders need to liquidate their positions. When they are liquidating the positions, it is again creating a supply in the market. If they are creating a supply in the market, again there is a decline in value. This decline in value again will create a problem. Okay, so this is a pro-cyclicality. More margin requirement, more selling. More selling means more losses. More losses means more margin requirement. Again, this cycle will go on. Then the CCP's risk. Again, these are the basic: admitting the member, valuing the transaction, evaluating the initial margin, managing the system of netting, margin transfer, and everything. Okay, so then we have the CCPs. The dangers that CCPs face are as follows: positive correlation among the defaulting members. Generally, when the market is volatile, members default. If the one member is defaulting, if one member is facing the problem, then almost all the members will start facing the problem, because if this is from the market condition. If this is an idiosyncratic risk, means happening with the one member, then there is no problem. But generally, the traders or the members face risk when there is a volatility or problem in the market, and it will affect equally. So there is a positive correlation among the defaulting members. No consideration to credit quality of the member. This is a problem with the CCP. CCP does not consider the credit worthiness of the member. They only consider the credit worthiness of the trade, like that. The members might resign if one member defaults. Other members might resign, because otherwise they would have to pay for all the losses. Okay, they will be in trouble for that reason. Model risk. CCP use models to calculate the variation margin, initial margin, maintenance margin. And if the models are inaccurate, if models are not properly calibrated, then all the margin requirements will be improper, and ultimately CCP will face the risk. Liquidity risk. This is the possibility again. Okay, so generally, if there is a situation in the stress market condition, if the CCP is unable to liquidate the position, or the member is unable to liquidate the position, this will create a liquidity problem. Then other risk: fraud, computer failure, litigation cost, and losses on investment on the initial margin, the variation margin. Remember, all the initial margin and the variation margin paid to CCP, CCP will invest it somewhere so that CCP can generate a return on those funds. Then, reading number 7, futures market. Here again we have theoretical discussion. This is the open interest discussion. So first again, you all know the CCPs, the exchanges and the operations of exchanges. Open interest. What is open interest? Assume exchange is completely empty. This is the first day of exchange. I take the long position in the same contract in which you are taking the short position. Total number of contracts are 100. So what is a open interest? 100. I take the short position of 50 and you take the long position in 50 in the exactly same contract. So what is the open interest? This is the question.
0.
Initial open interest was 100. I'll note it down, just a second. I take the long position, you take the short position, and total number of contracts 100. Open interest 100. Sometimes GAP asks this question, open interest question in exam. Then I took the short position. Total number of contract 50 in same contract, and you took the long position. What is open interest here? What is the open interest here? Open interest means the contract standing at exchange. Simple. Total open contracts at exchange. 50. Okay. Next. I took the short position in some XYZ contract and I got buyer. Total number of contracts 100 and the buyer was X. He took the long position in the same contracts. Open interest. Now remember, open interest is not among the parties. Open interest is in exchange. Open interest in exchange.
0. Since it cannot go below 50.
You have to answer. Correct, 150. Then
It doesn't matter how, what position is it, like long or short.
open interest is open interest. Executed contract is open interest. Always, every contract will have one long, one short. This is the very basic, like the defined thing, right? So here, when there
We
is,
don't have to net them. We don't have to net them off, like long and short, net them off and then present the latest value.
there is no
Or
netting.
the-
There is no netting. Now see here. First, here, this is the start of the exchange. This is the beginning of the exchange. Okay, now here, one is taking, like the S is taking the long position and Y is taking the short position in the same contract. Open interest, open contracts will be 100. If I take the reverse position to square off, which we call it as a square off, if we square off that position, so we are cancelling those contracts. So here I cancelled the contract. 50 contracts are cancelled. So 100, it started with the open. So 100 were open. I cancelled 50 out of them. So now I have open interest is equal to 50 only. If I would have taken, say, short position in 40, then open interest would have been 60 only. Now this is like the contract is closing here. This contract, like the 40 contracts are closing because at the time of this long and short and long, both the parties are same. Okay, so you and me, if we are we'll take this example, you and me, I take the long position in 100, you take the short position in the same 100 contract. So what are the total number of contracts? 100. Now I took the short position, I took the opposite position in 40, you took the long position in those same 40. So for you, total short is 60, for me total long is 60. Open contract or open interest is 60 only. Now I take long position, sorry, I am taking short position. I am taking short positions with some XYZ party, some third party, and these contracts are executed. So total number of 100 contract will get added in the open interest. So 60 plus 100, total 160. Now, Mr. X takes short position in this contract. Okay, so whatever contract we enter into, total 100, and there was some Z party who took the long position here. What is open interest?
150.
Okay, we'll collect the answers. Someone said 150, someone said 250. Other answers? Ricardo 250, Anil 250. Anu 50. 250. So we'll do the voting and we'll see. We'll calculate the probability of how many students are able to take this correct or will be able to take this correct in the examination. Now just always focus on the situation here. Okay. Mr. X had initially like the long position. Now he took the short position. So he simply closed his position. So total interest will go down because he closed his position, will go down by 100, but immediately there is one party who is holding these 100 contracts for him. So it will go up by 100. Simple. So open interest will be 150 only. Again, we'll go by the same example. We started with this, like here, let's assume this 50 only. We started with this scenario. So I was taking the long position, you were taking the short position, then we squared our position by 50. Ultimately we got a 50 as open interest. Then I took the position with a third party, some XYZ person. And then total interest was, total open interest was 150, right? Now that person sold his position. See, this X sold his position to Z. So he simply sold his position to someone else, but still the open interest is 150 only. So contracts changing hands from one person to another is not going to reduce the open interest. Remember. So always look for new contract, and this is not the new contract. He is simply transferring his contract to Z. Okay. And please make sure you have to always remember, it doesn't matter how much practice you do for the open interest. You have to think patiently, and then only you will be able to solve the question on open interest. Okay. So this is the open interest. Always remember, highly testable. GAP likes to test this area. Then specification of the contract. What is the underlying asset? So it can be commodity, it can be stock or anything. But specifically for the commodity, the underlying asset should be mentioned. For stocks are stocks, right? Very simple. But for the metals or for the commodities have different qualities, and for this reason, commodities grade should be specified. So underlying specification should be provided in the forward contract. Okay. Specification of the forward contract. Contract size. What is the size of the contract? So in one contract, what is the quantity? 100 kgs, 10 metric ton, 100 ounces. It can be different. Okay. So you have to just remember the contract size. Then delivery location, where short will deliver or where will be the delivery. Okay, so suppose location should be provided. Delivery time, the month of delivery, simple. Price quotation, we discussed it in the bonds future, where we saw the price quotation, how price should be quoted. So this generally, the price quotation is not important for say commodities or stocks, because it will be quoted in very simple format, but this is important in case of the bonds and similar scenarios. Okay, so price quotation should be provided in the forward contract, and here we are talking about the forward contract in general. Price limits, upper limit and the lower limit, how much price can move, and this is mainly applicable for the commodities, highly applicable for the commodities, because high fluctuation in commodity will create a problem for overall economy. For this reason, position limit, this is applicable for the speculators, like how much position they can take. Remember, position limit is only applicable for the speculators and not for the hedgers. If you are hedging, you can take any position. If you are speculating, then there are the limits set on the speculators. Okay, delivery mechanism, if a short seller wants to deliver, then what is the delivery mechanism? Generally, remember, generally contracts are settled by the cash, but if someone wants to deliver, then this will be the process. And the process is: step 1, notice of intention to delivery will be provided to CCP. Who will provide this? Short position holder wishes to make the delivery, he will provide this notice. Okay, I want to deliver, and this will happen say 15 days or 1 month before your settlement date. Then CCP will choose one or more parties with a long position to accept the delivery. Now this choice can be made on random basis, lucky draw basis, or simply CCP will ask if anyone is willing to take this position, if anyone is willing to take the delivery. So in this order it will be adjusted. Okay, so first CCP will ask, do we have any member who wants to take the delivery? No members. Okay, then based on the lucky draw, then they have to take the delivery. Once the notice is allocated to the member cannot refuse. Who will allocate notice? Like the CCP will give notice to other member who is having the long position, and then long position holder is forced to take the delivery. So settlement price is the last trading day's price, and long needs to pay for the delivery, and the delivery at the location as provided by the short in the notice. Okay, and the location will be decided based on this. Okay, as per the short's requirement. Now cash settlement. So in most of the cases, the futures are settled by the cash or settled in cash, but regulators wants a settlement by delivery, which is really problematic. I don't know why regulators wants delivery, physical delivery, but their intention is very simple. Like if the physical delivery is there, then there will be less speculation in the market. Okay, so it won't become a gambling. So only the needy people will take the positions. Miscellaneous discussion related to the futures. So patterns of future prices, market participants, okay, the locals and the futures commission merchant and introducing brokers, just know the basics. Then order types, very important. So first is the market order. One more thing, in open position, open interest, we discussed the open interest. Remember, open interest and open trades are very different, totally different. If I place order in the market that I want to take long position in 100 calls, and say currently the calls price is $10, and I said I want to take the long position at $9, my order won't get executed. So this is the open order. Okay, once my order is executed, this becomes an open interest. So you have to always differentiate between the two, open order and open interest. First of all, market order. What is the market price? I am willing to buy at that price, buy or sell at the available market price is the market order. And at the time of purchasing, at the time of taking this position, I will decide if I want to take the market order, limit order. Stop loss can be used at the time of taking position or after taking position. So there is no as such requirement for the stop loss when to take the position. Then stop limit order. Then there is a market if touched, discretionary order, and duration of order. Based on the duration of order, we can have the categorization. So first of all, market order, as we discussed, what is the market price? The buyer and the seller are willing to trade at that particular price, and they are not putting specific limitation or condition that at this particular price I want to buy. For example, if as I said, like the option price is currently 10, buyer will always want a lower price and seller will always want a higher price. So if Seller puts the price of selling at $11. Market price is 10, and I am saying that I want to buy it at 9. So this is limit order for both the buyer and seller. So buyer is putting a limit of lower price, seller is putting a limit of higher price. So this is the added condition. In market order, it is simple. Whatever is the price I want to buy. In limit order, I want this particular price. If this is the price I am getting, I am willing to buy. Otherwise, I won't. Stop loss order. I bought it. I will put the stop loss. Simple. I bought it at $10. Simple. And then I think like if the option price falls below say $8, I will generate huge losses. So I want to avoid that. So I will put the stop loss condition. This is the added condition to that particular order. I will add the stop loss condition say at 8. Once if the market falls, if the option price falls and it reaches to 8, my order will be squared off. So my position will be sell. Okay, my position will be sold, and it will be, if I have the long position, long call, it will become a short call position, and my position will be squared. I will have 0. Stop loss. Stop limit order. So I want to buy at 9, sell at, or create a stop loss at $8. Market if touched. So the order should be executed if market reaches to certain level. So this is again very simple. Market if touched, MIT order. Then discretionary order. This discretionary order is delayed by the broker, and broker will try to find a better price. Always remember, for buyer, broker will try to find the better price, which is in the lower side. For seller, it is in the higher side. And this is simple. This is based on the broker's assessment. If you have really good broker, then discretionary orders are good. Otherwise, don't go for it. Duration orders. So here we have fill or kill. Immediately it should be executed. Otherwise, it should not be. Okay, so it will be killed at the same time. Cancelled. Then there is a GTD, good till cancelled. Okay, so good till cancelled means if I place order today, generally order will be closed, or my position, if the order is unexecuted, if order is open order and no one is willing to sell me at that particular price because I am taking the buy position, so it will be good for the day. Okay, GTD. After this day, all the positions will be open, trades will be closed. Okay, and next day I have to place the new order. But if this is a good till cancelled GTC order, then till I get the price, till I cancel its buy manually, then till that particular point the order will stay. Otherwise it will get executed. If I get a favorable price, then it will get executed. Otherwise I have to cancel it if I am not getting the favorable price. Now regulations for the futures market. There are the accounting rules, and then we have simple. In accounting rules, there is a typical problem. I'll just give you the summary of the problem. There is actual position. There is a hedge instrument. There is problem with accounting rules. So those who are aware of hedge accounting, financial instruments accounting, though you know what is the problem. Those who don't know, I will give this basic summary because explaining the financial instrument in this particular class is totally practically impossible. Now see, whatever the losses or gains you are generating on your actual position are reported as per the regulations. Okay, the accounting rules. You are supposed to report it, or you are supposed to account for it in your books. 1. But if you take the hedge position to protect yourself from all the risk, so automatically hedge will create a compensating position. Now accounting rule simply says you have to report your existing position. If I have say gold position, huge gold position, and I am generating losses on that position, I have to report it. But at the same time, I also have the hedging position, hedging instrument, which I took the futures contract for the hedging. So now accounting rule says, no, you are not required to, or you are not expected to, or you are not supposed to report hedging instruments gains or losses in your books. Now what's happening? In reality, if I generate loss of $100 on actual position, and I also have gain on hedge position, my actual loss is 0. But accounting rule says you have to report this and you have to defer it. Defer the reporting. Don't report it now. Report it whenever you will close. Now what happens? If there is a financial year closing at this particular point, what will happen? I will substantially report higher losses. Substantially higher losses will be reported in my balance sheet. And when this contract will be closed, I will report substantial gains. unnecessary, right? So this is the problem. So this you have to remember. There is a like accounting, because of the accounting rules there is a problem, and this problem is not universal. Accounting rules are generally modified based on country to country, which is known as a convergence of accounting rules, accounting standards. So here these are the highlighted points which you are supposed to remember. So as I said, okay, so hedged position could lead to increased volatility in reported profit. Remember, this is a reported profit and not the actual profit. If the hedging is not accounted for, one thing. And I already explained to you what's happening. So initially you are unnecessarily reporting losses, then you are unnecessarily reporting gains, where you have no situation of profit or loss, right? Now we have the FASB. Okay, Financial Accounting Standards Board has issued guidelines for hedge accounting which cannot be used by the US companies. And then we have the IASB. FASB gives IFRS, IASB gives US GAAP. So rules for the hedge accounting again. So IASB also gave the similar rules for the hedge accounting, and it must be fully. If you want to account for the hedge, then it must be fully documented. This must be classified effectively, and its effectiveness should be tested periodically. So these are the conditions. Okay. Fine. Then generally the futures contract are treated as if it is closed out in the tax year, and the profit and losses charged to the for the taxation. So this is for the taxation purpose. So this is page number 74. This is not important for you. I just gave you the basic, like why do we have two boards? So US GAAP is the US board, like FASB is the US board, and IASB is the Europe's board. Okay, so this is like IFRS is predominant or have the dominance in the accounting industry compared to US GAAP. Okay, so US GAAP is only applied by US companies in the US. Okay, so even in India, we are following the IFRS only, the converged IFRS, not the US GAAP. But some standards are according to US GAAP, some, not all. Now, pricing of forward and futures. So we'll focus on one thing only. As we know, the rule is forward price is equal to spot price and then plus adjustment minus adjustment. Okay, so plus A minus B. Plus A, all the expenses, minus B, all the incomes. To whom? Plus expenses to whom and minus income to whom? Long or short forward?
Long.
Okay, so someone is saying long, then. Any other answers? Simple. Expenses to short, incomes to short. Simple. Why? I am going to sell you at the end of 1 year. I have to maintain the asset. I will bond the expenses. I will get the incomes. So asset is with me till you take the position, till the settlement date. And that's why expenses of short and incomes of short are adjusted. Simple. Start with the expenses. Whatever you can remember, tell me. And then if there is any requirement, I will put. Give me the expenses incurred by the short. Interest. Next.
Taxes.
From the perspective of forward future pricing. Loss of interest. If you just remember this much.
Maintenance.
What?
Maintenance of underlying.
Give me the proper words, correct words which are used in the book.
Convenience.
Convenience. Yield is expense. Is convenience yield expense?
Income.
Then you people are taking too much time here. Too much time. Storage cost. Income, dividend, lease. So two expenses. Loss of interest and storage cost, convenience yield, dividend and lease rate. So these treatments we have to handle. This is like the treatments are very simple. You have to simply just a second. This was using futures for hedging. Okay, so first we'll cover the reading number 9, then we'll come back to reading number 8. So pricing of forwards and futures. So we are discussing reading 10 and 11. By mistake I started 10 and 11. I don't know why. That's fine. So let's discuss the forward future pricing discussion first, and then we'll see the previous discussion. Now see here, first of all, the forward price is equal to underlying price plus A, which is the adjustment for the expenses, minus B, which is the adjustment for the income. So here we have the interest, storage cost in the expenses. Incomes are convenience yield, dividend and lease rate. Now the formula is very simple. F is equal to, if we are considering only storage cost, then the formula will be S plus storage cost, simple, and then this will be adjusted for the time period, e to the power RT, simple. Assuming continuously compounded rate. If you assume the effective rate, then the same formula will be S plus U storage cost, e to the power 1 plus R to the power N, like this. Simple. Now see here. The storage cost can be provided in two variations. First variation is in the proper expense format, like the dollar format. So the storage cost can be provided in the dollar format or in the percentage format or the yield format. If it is provided in the dollar format, simply use directly. If this is provided in the percentage format, this will get adjusted in the R plus U multiplied by T, like this. Okay, so you will add it. Then if the storage cost is provided in the dollar format, there are three possibilities: paid in the beginning, paid in the mid, paid in the end. Tell me the treatment. Try to recall.
Beginning directly.
F is equal to, give me the formula if it is paid in the beginning.
Same as of
S plus U e to the power RT is the formula. Second, paid in the mid, that is between the inception date and the settlement date. F is equal to S plus present value of U calculated. The presenting should be done for, say, if you have the 1 year in the total time to maturity is 1 year, and you are paying storage cost at the mid, say after 6 months, then you have to calculate the present value, discount it for 6 months, and then add it to this underlying price, and then take it to the e to the power RT. If it is paid in the end, F is equal to S plus, tell me,
As E R.
simply first take this underlying to end and then plus simply add the storage cost here. Fine. Storage cost done. This is the interest rate treatment. Done. So interest rate can be provided in two formats. One, this is continuously compounded. This is effective. If nothing is given in examination, go with the continuously compounded. Then we have the dividend. Dividend, same rule is applicable. Dividend can be in the dollar format and can be in the percentage or the yield format. Again, tell me the formula. If you remember the formula, you will be able to handle everything. Don't bother about it. And build formula instead of like remembering formula.
S plus present value of yield, dividend, equals to RT.
S plus dividend.
Present value of present value of equals to RT.
S plus S into
Just a second. We'll write one by one. Tell me. We are calculating for dollar first.
$. Sir, S into present value of dividend into e की power RT.
Okay, this is one. Second formula.
For that, the other one, S into
No. Someone else was telling the formula. For the same
S
dollar.
plus S plus present value of dividend whole to the power whole e to the power RT.
Okay. Next formula. Jairam, Ricardo, Neha, Nitish, Sanjana, Daud. Any formulas from your side? We are calculating forward price or the future price. We have the underlying known as S. We have the dividend only impact, and obviously we have to consider the interest rate only. So we have to adjust the dividend for the calculation of the forward price. What should we do? Good. How many days are left for exam? 5, 10. Really amazing. First, dividend is income. It should be reduced. E to the power RT, assuming you are getting dividend very soon. If you are getting dividend, say in between at some XYZ point, then present value of dividend, then e to the power RT minus present value of dividend. You have to reduce it. Okay, now in the yield format.
As e to the power R minus 2t. R minus 2.
Correct. Okay, then this is for the dividend. Then we have convenience yield and lease rate. Okay, so CY and L. Tell me the formula for forward rate calculation when we have convenience yield or lease. And convenience yield will always be in the percentage format, and lease is in the dollar or percentage format. So simply tell me the percentage format. You have the dollar treatment, you already know. Quickly, forward rate is equal to S0 e to the power
into 1 plus
1 plus आगे
plus R की power T. Jerome.
Yeah, mute. E to the power r minus lease if it is in the percentage format. F is equal to S0 into e to the power r minus convenience yield into t, like this. Okay, so these are the formulas you have to apply. Formulas are very basic, straightforward, simple, nothing like complicated here. So we discussed interest rate.
Convenience yield and lease rate has the same treatment as a big rate, right?
Yeah, because you can either have lease or you can have convenience yield. You can't have both at the same time.
So we don't use the discrete formula here, only the.
Generally the exponential formula.
Oh.
If you want to use, you can. There is no problem. If the rates are given in the effective rate, okay, which like I don't think ARP will provide like this, but if the rates are provided in the effective rate, and let's take the example, S0 is equal to 100, time to maturity is 1 year, risk-free rate is 10%, convenience yield will take first example of say 2%, lease rate will take the example of 3%, and if this is a scenario and risk-free rate is 10%, right, and all are effective. So in this particular case, we have to calculate F is equal to 100 multiplied by 1 plus 0.10 divided by 1 plus 0.02 for the convenience yield, and forward is equal to 100 multiplied by 1 plus 0.10 divided by 1 plus 0.03 for lease rate, like this.
Quick question: Can lease and convenience yield be there at the same time?
No, not possible, not at all possible, because convenience yield you generate when you hold that commodity with yourself, and lease you get when you lend or rent it out, right? So both can't happen together. So that's why convenience yield and lease rate won't happen together. So either convenience yield or either lease.
So in the exam, they'll give us either.
Yeah,
Suppose they give us both and tell us to calculate the forward price.
if they do this, then okay. So if this happens, then the solution is this only. Okay, so simply S into e to the power. I am assuming the convenience yield and lease rate both are provided. Maybe there can be like different reasons. So R minus Q minus L into T, like this.
Okay.
Okay, so simple. The rule is very simple. If you have expense, add it. If you have income, reduce it. Simple. So if you have income, reduce it till any extent. It doesn't matter. It doesn't matter if this Q plus L, or simply for now, let's assume this is lease rate only. Say lease rate is 10% and R is say 5%. Even if this is the case, you can reduce it, and now your forward price will be lower than your spot price. Okay, in one mock I remember I did this. I used risk-free rate as 5%, lease rate as like 10%, and students started adding it because otherwise their forward price was lower than the spot price. But it can happen. Okay, so you don't have to bother about it. Simply go ahead with the basic calculation. Like whatever is the rule, fundamentals, stick to fundamentals here. Okay. Okay, so investment versus consumption asset. So investment assets are which you use for the investment. Consumption assets are for the manufacture or for the consumption only, like the jet fuel in the airplane. Short selling concept, you already know what is short selling. You borrow it and you sell it like this. And short seller is bearish on the particular security. Then forward pricing stocks and commodities. First, interest rate, we treated it, we saw. Storage cost, we saw the treatment. Dividend, there was correction, and this, I guess this is a corrected copy only. Okay, no, this is not corrected copy, so minus. Dividend, we saw the dividend treatment. Lease and convenience yield, I intentionally covered lease and convenience yield in notes together so that you can get the proper impression. See, with convenience yield, with lease rate. Then treatment when the rates are given continuous and effective. So effective like this, continuous you already know, e to the power format, okay, like this. Then forward versus futures price. Here we have few points to note. If the asset prices are positively correlated with the interest rate, this makes the future contract more lucrative than the forward contract for the long futures holder, and hence the futures will be priced slightly higher. Okay, so reason is given. Reason is not at all important for exam purpose, because your exam is near. Just remember the key statement, even if you are unable to recall the reason now. Don't bother about reasons. If the prices are negatively correlated with the interest rates, this makes the future contract less lucrative than the forward contract for long. Remember, this is for long, and hence the futures contract will be priced slightly lower. Okay, so you have to remember these two statements, GARP's favorite statements. Then the arbitrage opportunity. We here in this particular chapter we saw how to calculate the theoretical price, but actual price depends on the demand and supply in the market. So there are two possibilities. Forward price may be greater than the actual, or theoretical price may be greater than the actual, or theoretical price may be less than the actual price. So in these two cases we have to we can get the arbitrage, and the arbitrage should be executed in a defined manner. This is properly defined. You don't have to bother about it. If the theoretical price is less than the actual, if you are unable to understand this particular area, just remember it. Just remember it. Okay, so because this is considered as a difficult area by GARP, GARP will ask you straight question. Whatever is given here, even if you are able to solve this, you will be able to solve everything in the examination related to the arbitrage. So first of all, FT is less than the FA. So future price theoretical as per the formula is less than the actual. Then the arbitrage is known as the cash and carry arbitrage. If the opposite is there, that is the theoretical price is greater than the actual price, then the reverse cash and carry arbitrage is there. Okay, it is known as the reverse cash and carry. Now cash and carry, theoretical is less than the actual. I am repeating this again and again so that it sticks in your mind. So theoretical is less than actual. Cash and carry arbitrage. At time t0, you have to apply these steps. You have to borrow funds, buy security and sell futures. And at time t1, obviously you will be settling your positions. Simple. Just remember like this. If you borrow today, how will you settle the position? By paying loan at that particular price. If you buy security and sell futures, now how will you settle your position in sell futures? By selling security and receiving cash. Simple. Now here, just remember BBS. If you are unable to remember this, BBS, this is applicable for cash and carry. Borrow, buy, sell. Borrow what? Funds, obviously. Buy what? Security. Sell futures. If you borrow funds, remember, think like this. If you borrow funds, these funds can be utilized to buy security. So that's why there is a buy security. And for selling future or buying future, you don't need any cash flows. Okay, so there are no cash flows in this particular case. So buy, sell. Borrow funds to buy securities and sell it in the future. Like this. Remember like this. Then reverse cash and carry arbitrage. When the theoretical price is higher than the actual price. Steps to follow. Sell, invest, buy. What do you sell? Sell the security. Obviously you don't have it right now, so you will short sell it. Sell security, invest those funds at risk-free rate, obviously, and then buy futures. Okay, so here this thing is SIB, and this is for RCC, reverse cash and carry. Okay, I'm not at all good with these things. Okay, so BBS and SIB, but if you say like you are unable to remember this by understanding, then the only alternative is this only. Okay, just remember it by this. Okay, and I do understand these things are complicated to remember by default. Even if you are able to remember like this, no one is going to say, okay, how can you remember like this? Okay, so don't bother about it. Now see, first of all, we have example here. So spot price is 100, risk-free rate is 10, theoretical price is 110, actual price is 120, and time to maturity is 1 year. Now, current spot price. Now here our steps are borrow, buy, sell, right? So how much to borrow? Borrow enough amount so that you are able to buy security. So currently the underlying price is trading at 100. Obviously how much you will borrow? Borrow 100. So plus 100. You will buy security minus 100. So cash out, and then sell futures, no cash flow. Totally, like in net, this is zero cash flow. Okay, if you take the total, this is zero cash flow. At the time T1, at the maturity, obviously you have to settle your positions. So first of all, you will sell your short position. Okay, so sell short as in the short futures. So sell it, you will deliver the commodity, and actual price was this 120. So you will get plus 120, and now you have to repay your borrowing. Repay your borrowing at what amount? So simply whatever you borrowed plus interest rate. So 100 plus 10%, 110. 110. Settle the position and repay the borrowing. So you got 120 by selling it in, selling your asset, and you are repaying 110. 120 plus 110 minus 10 net arbitrage gain. Simple. Here we have calculated or theoretical price greater than the actual price. Now here the steps are: short sell security. Obviously you will be able to short sell security at the point T0 at the existing market rate. Existing market rate is 100 only. So you will get plus 100. Now you have to invest this in the risk-free rate. So minus 100. So plus 100 by short selling it, minus 100 by investing funds, and then buy futures. Okay. 0. Net is 0. Then we are settling our positions. Obviously we invested our funds. So we will withdraw those funds. So you will get plus 100. How will you get plus 100? So we had like 100 to invest, 10% interest rate, and now you have the 110. Then settle the long contract by taking the delivery. So we will take the long, we will settle the contract. So this is minus 100 because our contract term was, our contract price was 100 as per the market. Settle it, you have plus 10. Remember we short sold, so we borrowed securities from someone else. So here, when we take the long position, when we are buying it in the futures, that is at the time T1, we will have the security and we will return it to that particular person from whom we borrowed. That is, in simple terms, it is automatically settled by the broker. Again, you will get the plus 10. Okay, now cash and carry and reverse cash and carry. Now valuation versus pricing. Valuation is calculating value and pricing is pricing, whatever we saw. So here, let's see the valuation of forward contract.
Okay, I found this on the web for valuation of our contract. Check it out.
Valuation versus pricing. Pricing we do by formula. Value is calculated for the mark to market purpose. Now here, this can be again better understood by the example. And here the value of the forward contract is simply the spot price of asset minus present value of the forward price. You have to remember this rule. Spot price of asset, if the asset is stock, then adjust it for the dividend income. Spot price of asset adjusted for dividend income minus present value of the forward price. Remember like this. Current spot price is $1,000. Risk-free rate is 10%. Dividend yield is 2%. Now here, calculate the forward price and value of the forward contract on the next day, assuming the spot price is increased to 1050. First of all, forward price is equal to 100. So here we are applying the or assuming the effective dividend and effective interest rate. So 10% and divided by 1.02. Answer is 1078. Now why are we calculating the present value here? Simple. So we are calculating present value because this 1078.43 is applicable at the time T1 at the maturity, and we are valuing it right now. So to value it, we need the present value. Simple. For the valuation of the forward contract, 1050 multiplied by adjustment for the dividend. So this is the adjustment for dividend, very basic, 1 divided by 1.02. If you are using the exponential term, then e to the power minus r minus qt. So here this will be 0.02 into 1 like this. So you will discount it. This particular portion is we are discounting or adjusting the underlying price for the dividend, adjusted spot price and present value of futures contract. Simple. And this is the valuation. And recently, I guess in exam, GAP asked question on valuation. I guess previous or previous to previous. Now, special points related to commodities, forwards and futures. So what is different in commodities, forwards and futures compared to the stock forward and future? So we have storage cost here, location dependency, like where to deliver it. We can have the lease rate here and risk-based pricing. Okay, so financial assets are priced on the risk taken by the investor. However, The factors which influence the price of the commodity are very different and can range from time, duration, location, and everything. Now, the factors impacting the prices of agricultural commodity, metals, energy, weather, derivative, agricultural commodity. Now, what you have to remember here, please focus here. So, demand is evenly distributed because we are eating on a daily basis, but harvesting is seasonal. So, this creates a mismatch. This is what you need to remember. Metals, not affected by the weather and may be stored at a low cost, so storage cost is low for the metal. Prices are influenced by the factors such as cost of mining and production, government regulation, foreign exchange, and so on. Energy, demand changes substantially. This is different from in agriculture's case, production changes substantially, like there is a volatility in production, unevenness in production. In energy's case, there is unevenness in the demand. The nature of energy product is vastly different from one another. Okay. Now, energy to energy product differs with each other. So, crude oil, for example, is the easiest to transport and has a comparable market pricing around the world. As a result, crude oil futures are stable derivative. Remember this for your exam. Electricity is another energy product that has a that is difficult to store. The demand for the electricity, on the other hand, is quite dynamic and varies from day to day. I don't know why for like crude oil, the demand is stable. Okay, but still remember like this. As a result, the electricity derivatives are extremely volatile. Natural gases is a final energy product we will discuss here. So natural gases has a steady production but changeable demand that varies by season. So natural gas is expensive to store. Therefore, futures cost will vary by region. Weather derivatives are the derivatives on the weather events such as monthly rainfall, temperature, or so on. So energy corporations are primarily users of the weather derivative. Now the contango market and the backwardation market, just remember this. Contango is the natural market, backwardation is the slightly abnormal market. In contango, what will happen? The future price will always be greater than expected spot. Okay, future price is greater than the expected future spot price. We are talking, this is the EST like this, and this is F. Normal backwardation, this is EST is greater than F. So if this is a scenario, then normal backwardation. And if this is the scenario, that is your expected spot price, expected future spot price is less than the future price, this is contango market. Okay, contango is expected. Now the basis risk. Basis risk is simple, very simple. The spot price minus futures price, whatever is the basis. Basis means simply this difference. And ideally, if you have the perfect hedging scenario, then this basis should reduce as the time to maturity comes closer. Now, the basis risk, the formula for the basis risk is spot minus future, 110 minus 120. And in the contango market, basis is negative or positive? Negative generally. Okay. Now here, if your underlying is not properly matched with the derivative you are using for hedging, then you will have the basis risk. That is, if there is no matching at the maturity, if there is no matching, then you are exposed to basis risk. You won't be able to compensate all the losses fully with the help of derivative. That's the basis risk in simple terms. Now see, key properties of basis risk. Basis risk decreases with respect to time. Basis is zero at the maturity for both the asset which is being hedged and the underlying, like in simple terms, it is zero. So what are the sources of basis risk? If you close your future position earlier, so this is the scenario, basis will close at this point only, remember, at the time of maturity. But if you close your position here only, so this gap is your basis risk. And then the asset hedged is different from the underlying. So obviously you won't have the one-to-one correlationship there. So you will miss on the basis. Okay, so you will have the basis risk. Okay, so this is the end of our forward future pricing. and we skipped the hedging. Now we will discuss hedging first. So hedging versus speculation. This is reading number 8, futures for hedging. Hedging versus speculation. Basic definition: hedging is for the purpose of reducing your exposure to existing risk. Speculation is to get the advantages from the expected price movements. Second. Then long hedge versus short hedge. So long position in contract is the long hedge and short position in futures contract is the short hedge. That is the position you are taking. If you think or if you have exposure to price decline. Question for you. If you have exposure to price decline, what type of hedge you will enter into? Or if you have exposure to price increase, what type of hedge you will enter into? Long hedge or short hedge?
Long hedge. Long and second short.
Long hedge and short hedge. Very simple. I am afraid of price. Other answers?
Depends on whether you're bullish or you're bearish.
This is hedging. There is no bullish and bearish. I have stocks.
Short.
I have stocks. I have exposure, obviously, to this is I own. Exposure to, obviously, I am afraid of price decline. So will I take the long position or short position in hedge?
Short.
Short position. This is short hedge. Now I have short sell position. I am afraid of price increase. What will I do? Long position. This will be known as a long hedge. Simple. Now please remember what type of mistakes we are making here. I'll give you a very simple suggestion for exam. If say 100% content is given in your book, we are just assuming the Falcon's book. If you are able to replicate, remember properly, clearly 80% of the curriculum in exam with 100% assurance, okay? So you have to maintain 100% confidence in 80% area. I'm just assuming like you are leaving few topics here and there, you are not preparing 1 or 2 topics, that's fine, no problem with that. But the 80% content out of 100% should be prepared with the 100% confidence, and you have really high chances of clearing in exam. Even if you are not solving all the questions, even if you are not solving like 1,000, 10,000 questions and like that, just make sure you know every basic thing given in the book. You are able to understand every basic thing given in the book. You are able to solve all the illustrations given in the book. So if you are able to do this, you have like amazing chance. However, if you prepare 100% and in exam you are not able to replicate this properly, so 70% only. This 30% mistake, like the area of error, will create a mistake in multiple questions unnecessarily, and it doesn't matter then you are well prepared or not well prepared, you will make mistake in a lot of questions, and this will lower your probability of passing an exam. So the key to clear exam is know all the basics by heart. If we make mistakes like this, and you must have seen like consistently we are making mistake in the basic area, and it's not only applicable for you. I'm not saying like you are you as a like the students who you are making mistakes. Generally students make this mistake, so I'm just giving you the recipe to clear exam. Okay, so make sure you are amazing with the basic concepts. If even if that's like done, you are good to go. And make sure you appear for mock test. Lot of mock tests are available and no one is appearing for the mock test. Like few people are appearing for it, but not everyone. Now hedging is very simple and straightforward. So we'll start with whatever we are like provided, we have to just use those input values and process it and calculate the number of contract we will use for the hedging purpose. In this step 1, first of all we have to calculate the hedge ratio. Then find out number of contracts, and the formula for the finding out the number of contract is hedge ratio multiplied by, remember the formula is fixed, question in exam is fixed, everything is so fixed. Like if anyone makes a mistake in a hedging question, then this is really a disaster. Okay, now see here, value of the portfolio divided by future price multiplied by multiplier. What is this multiplier? Currently say future price is 100 and there are total 50 units in one contract, because we are calculating contract value, right? Number of contracts. 100 multiplied by 50 in denominator. Value of portfolio, say you have $10,000 worth exposure. Simply, this is the fraction you have to calculate, multiplied with the beta. How to calculate beta? There are two formulas, and this is the second area where students make mistake. Beta's formula is correlation of SFs. S means your underlying position, F means the future position or hedge position you are trying to use. Beta multiplied by correlation, beta is equal to correlation multiplied by sigma S divided by sigma F. Like this is a one common mistake. Beta is equal to correlation multiplied by sigma F divided by sigma S. This is the first mistake. I hope you understood what is the mistake. Sigma F is in the numerator and sigma S in the denominator. That's the first mistake. Remember this formula. This is the correlation of spot and future multiplied by SD of spot in the numerator and SD of future in the denominator. Alternative formula, which might be like you may require this formula. So if the covariance is provided instead of standard deviation and the correlation, then covariance of Fs. Covariance is covariance of Fs. So you won't get confused in this particular part. In denominator, sigma of F square. That is a variance of futures. Okay, so variance of futures contract. Just remember this formula. Okay, then we have this illustration. Value of portfolio, standard deviation is 10%. Futures is currently trading at 4,000. Standard deviation is 12%. Correlationship is this. Covariance is this. Contract size is this. Simple. I'll start with the calculation of, like here, I also like use question which requires you to calculate the correlation. Okay, so sorry, this is the hedge ratio. Hedge ratio using the correlation first. So 0.45 multiplied by 0.10 divided by 0.12. Simple. If you use the covariance, then this is the formula for covariance. In both the cases, you have the same answer. Total number of contracts required for hedging, the basic setup, beta multiplied by value of the portfolio divided by futures value multiplied by contract size. Calculate the answer. Now, to take the long or short is the second mistake students commit in the examination. What do you need? Long or short? Long, how many number of contracts are here? 18, 19 contracts. Always round it off. Long 19 or short 19? This is the question. If you have the net long portfolio, so you say this indirect hint will be provided in the question, like you own this much portfolio like this. Okay, so this is a net long portfolio. For hedging, you will take short. If you have net short portfolio, for hedging, you will take long like this. Okay, so you have to take the opposite position. And this is what you need to remember for the exam. Options are generally provided like this. There are a lot of students who are able to get this answer 19 because this is a formula based. In exam, they get confused. Okay, plus 19 or minus 19. Should we take the long or short? This problem comes because we are not focusing on the concepts and just focusing on calculations. So here, just remember how to get the short or long position. Even if you are able to remember this much, that's fine. Okay, so this is the first part. First part of hedging. Okay, then interpretation of hedge ratio. I don't think this is important. Beta less than 1. So that is beta is less than 1, the hedge ratio. This means the contract beta of contract is less than 1, say 0.375, indicates for every 1% change in futures value, underlying is changing by 0.375%. Beta is equal to 1, there is equal change. Beta is greater than 1, say 1.5. For every 1% change in futures value, position will change by 1.5%. Okay, simple. Hedge reconciliation, this was my addition to like curriculum for your understanding, not important for your exam. Then telling the hedge. What are we doing here? First, on day 0, we set up the hedge. Like we have the underlying, we have the hedge instrument, total number of contracts and everything. On the next day, there will be price change in the underlying and the future price. And we want to balance our hedge position so that we can match the new requirement. New requirement as in the changed position. Okay, this is the part of dynamic hedging. So we are adjusting our position. So for this, for the tailing of hedge, you don't have to do anything. Just this much setup is same as the previous, multiplied by spot divided by future of next day. Whatever is the for whatever day you are telling it, next day's values. Future is 4150 and 4010. So 4010 divided by 4150. That's it. Okay. This is the telling. Now see. Initially, you had position of 19 short contracts. After telling, you have position of, say, after telling, the requirement is, say, 17 contracts. Okay. Now, in exam, you will get two type of questions. First, question number 1. Number of contracts to tell the hedge. Okay, tailing simply means giving the effect of price fluctuation for the next day. In this case, A, B, C, D options are like this: plus 17 minus 17 plus 2 minus 2. Okay, then next question, type 2 question. Number of contracts to adjust position as per tailing hedge. Now here there is a difference. In first case, we are calculating number of contracts. Okay, so in first case we are calculating number of contracts. So in this particular case, if your answer is say 17 short, so tick this. If you get the same setup, and generally this is the pattern, same setup, but the now question is adjustment. Now adjustment is for this particular area. This particular area. Now tell me, will you take the +2 or -2 to adjust?
-2. Reduce the short.
Okay. Any other answers? Very basic question. Very. You have existing short position of 19 contracts. You want to reduce it to 17. So will you take -2 position or +2 position? Obviously. Yes, Ricardo?
Yes, and minus one.
Plus stands for long, minus stands for short. We will take the long position. We have right now 19 short. Here we have to add 2 long, which will give us 17 short, and that's why we have to use +2. Basic, you all know it, and still you are making mistake in this. Okay, so we have to avoid these things in exam. I hope you understood the problems, like what type of problems exist in real life scenario, like in the exam. Now see the beta adjustment. Beta adjustment is very simple and straightforward. In previous case, when we assumed the beta of like whatever we used for the beta, and we fused that beta in our formula, we were trying to reduce complete exposure. Now the thing is, like, there are companies who don't want to, or there are traders who don't want to reduce or eliminate complete exposure, because if you reduce complete beta, first of all, no risk, then there will be no gain. So some traders might want to keep some beta. So this is the required beta. So in this particular case, the hedging will work like this. So simple, the formula is very simple. In this case, GAP will provide you both the betas. Okay, so beta adjusted, like the required beta, and this is known as a target beta, and this is known as the portfolio beta or beta of asset. So simple, the portfolio value, futures value, same formula, beta adjusted. The general mistake is some students will do like the beta minus beta adjusted. If you make this mistake, gone. Okay, so here formula is very simple, beta minus beta, beta adjusted minus actual beta, or the portfolio beta. Now this is the illustration, portfolio value, beta of the portfolio, target beta, futures contract size. Now here we have to take 200 short position, 133 in this case. Okay, so originally if we assume complete hedge, then 0. If we adjust the beta and keep it beta, this is what we are keeping, remember. Okay, so we want a 0.5 beta in our portfolio and not 0. So minus 1.5, and here 133 contracts. Question, long or short? Long or short?
Short.
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 Correct. Okay, so short. Just question for homework. Can we increase the beta by using the same method? Is it possible to increase the beta? Okay, now stack and roll strategy. Stack and roll is very simple. First, you will take position in multiple, the contracts expiring in multiple months, and you will keep rolling it. So this is a stack and roll, very simple. if the trader has to hedge a lengthy period of for the lengthy period of time, say for 2 years, but only future contract available for the shorter periods, then he can use the rolling hedge forward approach. Rolling hedge forward, also known as a stack and roll, is a simple strategy in which the trader takes the position in the required amount of short-term futures contract and continues to take the fresh position in forward futures contract. Okay, so just for example, here I have say period 1 and 2. So I want to hedge these 2 periods. So I will take 2 futures contract. Both are expiring at this particular point. So my position is hedged for this. Then both will close at this particular point and I will enter into 1 futures contract. So stack and roll like this. Okay. So this is the hedging. Then next chapter is options market. This is the shortest topic for revision. First, intrinsic value calculation. You already know how to calculate the intrinsic value. Simple. This is S minus X or X minus S maximum of. There is also alternate formula for the intrinsic value calculation, but we generally don't go by the alternate formula. As per GAAP, this is the intrinsic value calculation formula. Okay, so call formula, put formula, same as your normal payoff calculation formula. Then types of underlying asset. So stock option, index option, ETF option, exchange traded funds. So here we have underlying as index, here we have stocks as underlying, and here we have index as underlying. Okay, stock indices as underlying. Then specifications of exchange traded options. So first we have the maturity. Here in this maturities case, you can ignore this particular part. Okay. First of all, like, this is unnecessary. From, like, if you ask me, this is unnecessary concept discussed in the curriculum. First of all, there is no importance or like there is no use from the academic level. Just for the information. So here in CBOE, this is again the specific domain. So CBOE's case, and options have a maturity cycle, and the maturity cycle goes like the January, April, July, October. This is known as the January cycle. February, May, August, November, known as the Feb cycle. March, June, September, and December, known as the March cycle. So Jan, Feb, March, and then it will roll for the 4 months. Okay, and alternate months. Now here, understanding the maturity cycle. So prior to third Saturday and after third Saturday. Why third Saturday? On the third Saturday, contracts are maturing. So if there is a prior to Saturday, then options will trade for. Remember this. You have to remember this. There is no understanding area here. Okay. So first, current month, next month, as per the calendar month. Remember, prior to third Saturday, current month, next calendar month, next 2 months from the current month cycle. For example, you are in, say, month of April. So cycle applicable is January. Before third Saturday, then your months will be April, May, July and October. So July and October will come from here, and April and May calendar month. If we are in September, then September, October, December and March. December and March. Again, this is for prior to third Saturday. After third Saturday, because now the contracts are expired for that particular month on third Saturday. So next month, next to next month, and next 2 months from the current month cycle. So next month and next to next month both have the calendar months, and then we have the next cycle. Again, after third Saturday, we are in April. So now third Saturday is over. The contracts will trade for May, June, July and October, like this. Just remember this is like more than enough. Then we have the weekly option, so which expires or which has a validity of 8 months and expires every Friday, weekly. Then we have the leaps. Leaps are long-term options, generally for 3 years. So question might be like, for the long-term option, what type of options are preferred? So leaps. Strike price, non-standard options. Strike price, you already understand what is the strike price. Again, this is very fact-based information, ignore this. Non-standard option, flex, click it, and Asian option. You have to again remember the key points here. Flex is the non-standard option where you will have some customization. Again, this is similar to the exotic option. Click it option are options on the indices which provide a payoff equal to sum of monthly capped returns provided by the asset. So the clicked options return will be capped at the assets return, like this. Then Asian option provides the payoff based on average price of the underlying asset during the life of the option. So again, Asian option we will discuss in the exotic option also. Now effects of dividend on the and stock split. First, just remember this one. There is no adjustment for the dividend in option. If there is a dividend on underlying, no adjustment is required for the option. Then if there is a stock split, if they say 1:2 1:2 split, then same split will be applicable for the option. So if underlying is splitting, option will also split. But if there is a dividend for underlying, then option won't get affected. Simple. This much you have to remember. So dividend will affect the underlying price, and it will not affect the option. Simple. Okay. It will not affect as in by structure. The structure is not affected. But if you have owned the option, then what will happen? The price of option will get automatically reduced because underlying, if this is a call option, underlying for dividend, underlying price will decline. If the underlying price declines for call option, the call price will decline. For put option, it will increase. Simple. For stock split, it is simple. It is divided into two parts. If you have say one option on one underlying, if there is a stock split, and now after splitting, you have two underlyings. So this option will get also like divided into two. Say underlying price was $100. Now you have two options worth 50. Total investors value or the portfolio is still at 100. So stock split or bonus issues won't affect the investor's portfolio. If you have the option which has a strike price of say 120, then after splitting, you will have two options which has a strike price of 60. Okay, strike price will get divided into two. Simple. Now we have the trading commission and the margin requirement. We already discussed the margin requirement. Is a trading basic text is here. Commission. So commission is like the per trade commission, then total value percentage based commission. So this type of commission will be provided in the exam. If you get question, this is 5th standard question. You will be able to solve it. If I provide you like say, okay, so total option value, total options are traded, which is a value of $100, and the commission is 2% of value plus $2 fixed. So can you calculate this? Yes, everyone can calculate this. So 2 plus 2 is equal to 4. 4 will be the total commission per order. There are total say 100 orders like this. So 400 commission for 100 orders. Simple. Margin requirement, same. Just ignore this particular part. If you want to read it out, just like the basic can be tested, but again, I don't think so. So options with the less maturity less than 9 months cannot be traded on margin. Options with more than 9 months maturity can be traded on margin with the maximum borrowing less than 25%. Okay, so your borrowing should be less than 25%. Long option holders is not required to post margin. Short call must post the margin. Traders can withdraw funds if the balance is more than the maintenance margin. Can withdraw funds. It is not necessary. Options margins are handled, and remember, options margins are handled by Option Clearing Corporation, OCC. Basic. Over the counter market, and then warrants and convertible bonds. So what are the warrants and convertible bonds? Convertible bond is like the bond which can be converted into the equity option. This is again for a price, and convertible means you will only convert if the prices are favorable for you. That's it. And that's why this is covered in the option discussion. Warrants are also same. So warrants are same to option. There is a strike price, there is a vesting period and everything. So you have to exercise it based on like whenever you are in the favorable position. If you can convert the warrant into equity or the stock at a favorable rate, you will convert it. Again, not very important for your exam. Then we have the properties of option. Very short discussion. Straight away, remember whatever I say and you will get question on this area only. Now see, simple. Remember this table. I'll just note it for you. Remember this table. Not this. Remember this section. Why I'm saying like this? First of all, learning objective. Identify the 6 factors that affect the options prices. Identify and compute upper and lower bound for the option prices on non-dividend and dividend paying stock. First of all, if you know what is, or if you remember what is the upper bound and lower bound, it automatically you will be able to calculate it. Simple. So these 2 learning objectives are mainly identify. Then we have the explain put call parity and apply it to the valuation of European and American option and with the dividends and the without dividend and express it in terms of the forward futures forward prices. Then explain the assets potential ratio. Just a second. Potential rationale for using the early exercise feature of American call and put option. So explain is covered in this particular area only. Okay, and then there is one put call parity discussion. Okay, let's just give you the put call parity. Now let's first start with the first table. We all understand what is the impact of underlying strike price, time to expiration, volatility, risk-free rate, dividend. Now just try to recall this in your mind first. So for the underlying price, if it increases, first of all, for the majority of the cases, this like the C stands for European, call European, P stands for put European, CS stands for call American, PS stands for put American. So if the underlying price increases, the call option price will increases for both, obviously, both as in the American, European, both. So there is only one exception here. Okay, so only we will discuss this exception for the American and European. Whatever is for the European, we will assume for American. We'll start with the again like the underlying price. If the underlying price increases, it will increase the call price. If the underlying price decreases, it will decrease the call price. So relationship between the underlying price and the call price is positive. Underlying price and put price is negative, because if the underlying price increases, put price will decrease. Time strike price. If the strike price increases, call price will decrease. If the strike price decreases, call price will increase, like this. So there is a negative relationship, and positive is for put. Time to expiration. Relationship is not properly defined. This is how we say it. Relationship is not properly defined for European call option and put option, but for American there is a positive relationship. Higher the time to maturity, higher the positive impact. Okay, like this. Now, volatility. Volatility is friend of all options. This is the statement you have to remember. Volatility is a friend of all options, so it will have positive impact on all options. Okay, all sorts of options. Risk-free rate, positive impact on call, negative impact on put, positive impact, negative impact. Dividend. What is the impact of dividend? Dividend reduces underlying. If the dividend is reducing underlying, so dividend and underlying are negatively correlated, and whatever is the correlation of underlying with the call or put, automatically it will generate a negative correlationship. The dividend will generate a negative correlationship with the call, and because of this relationship, the underlying relationship. Okay, so see here, dividend is negatively correlated and positively correlated, or negatively impacts or positively impacts. Very simple. Okay, easy to understand. I hope you understood the dividend part here. I'll just repeat this. If the dividend increases, underlying price will decrease. If the underlying price decreases, call price will decrease. So that's why if the dividend increases, call price will decrease. That's why there is a negative relationship. Again, same is applicable for the put option. That is, if the dividend increases, underlying price will decrease. If the underlying price decreases, put price will decrease, and that's why there is a positive relationship. Now next, early exercise of an American option. Call option early exercise, and this is the must remember. Explanations are not at all important. Please don't waste your time in explanations before exam in the revision part. Okay, Ricardo. Sure. The question is whether or not an American call option holder should exercise his option before its maturity. The statement you have to remember, reasoning you can ignore. When the stock does not pay dividend, it is never an optimal idea to exercise an American call option early. Our answer will alter if the stock produces a dividend, which we will discuss later. Obviously, you don't have to remember. You have to just remember this particular construct. Okay. So it is not, if for non-dividend paying American option, it is never optimal to exercise the call option early. Why are we discussing only for the American option? Because for the European, there is no such option, right? Now, impact of dividend on early exercise of the American option. American option can be exercised early before X dividend date. Remember, this can be done only before X dividend date if and only if the dividend amount outruns the interest gain from the early exercise. That is, dividend should be higher from this. This is the strike price and present value of strike price. Remember like this. Must remember. Okay. Then put option early exercise. American put option early exercise is the trade-off between. Now, it can be exercised or it cannot be exercised depending on the circumstances. So, properties of call option and put option may differ in some cases. In case of the early exercise, in case of the put option, it is sometimes optimal to exercise it even if the stock does not pay dividend. Remember, for the call, dividend payment is very important. For the put, dividend payment is not important. When we sell put option, when we exercise put and sell underlying, then you can invest it in the RF, invest your proceeds in the RF. Now here the trade-off is in between receiving the strike price early so that the investor can earn the risk-free rate. One. Second, benefiting from optionality in circumstances when the stock prices moves above the strike price. So you have the favorable situation, okay, in that particular case. Now, so there is a trade-off. Simple. Then, upper and lower bound. Simple. Upper and lower bound. Call option type. Call European American put option. Okay. Now, upper bound is very simple for call. It is S. Whatever is very simple, I'll just strike it down. Okay. So, S, maximum price of a call option can go up to the underlying price, assuming the strike price is 0. This is hypothetical. Assume the strike price is 0. So, what is a call payoff formula? Max of S minus X comma 0. So, S minus X will be S if we assume the X is equal to 0. So, S or 0. So, S. So, maximum. So, this is clear. So, now total we have 8. Here we have to only focus on 6 now. For put option, what is the worst possible scenario? Worst possible scenario. Yeah, that underlying company will go bankrupt. X minus S. So this S will be 0. If the S is 0, then automatically value is X. For the American put option, you can exercise it anytime. That's why X is the upper bound for the American put option. But in European's case, you cannot exercise it before the maturity. That's why the present value of X. Simple. Remember, why are we not calculating present value for the underlying? Underlying is present value itself, right? So underlying price S0 is the present value only. X is not the present value. X is the value applicable for the future. So we are simply calculating the present value for the European and not for the American. There is a reason for this. As we know, American can be exercised today. So there is no need to calculate the present value. European option cannot be exercised today. So there is need to calculate the present value. Lower bound. Now lower bound is slightly critical or slightly complicated. Why? The answer is very simple. Option price cannot go negative. That's the main reason. So simple. This is the for the call option. The formula is S minus X only. Remember, the formula is S minus X only. But as I said, always remember, for the call option, you cannot exercise, for the European call option, you cannot, or European call or put option, you cannot exercise it before maturity. That's why present value of X is applicable. So S minus X is replaced with the PV of, like S minus PV of X, like this. Here S minus X. And again, the for put we know the payoff calculation. So PV of X minus S and then X minus S, like this. Okay, so I hope this is simple. So I have to remember this. GAP likes to test this in the examination. Must remember, okay, there is no alternative. And reasoning behind the upper bound and lower bound is not all important. It is just like I thought to give you the details. Impact of dividend on early exercise. We already discussed this. No, we haven't, right? So dividend makes it more likely the call option will be exercised early. They make it less likely that the put option will be exercised early. This is the statement you have to remember. In general, exercising becomes less attractive for the holder of put option when stock price increases, interest rate decreases, time to maturity increases, and dividend expected during the life of the option increases. Simple. Okay, then trading strategies. Again, the easiest chapter, like I don't know, some of the students message me like they are facing difficulty in trading strategy. In my opinion, trading strategy is the easiest topic from the exam perspective. Defined formulas, defined rules, defined everything. There is no scope of ambiguity here. Okay. Now in trading strategy, we will discuss the different trading strategies. This discussion starts from the covered call and the protective put. Covered call. You have to always remember. What you need to remember here, just understand. Remember the compositions first. Whatever is the composition of strategy and when that strategy is useful or when that strategy is used. Okay, so two things. And third thing is maybe payoff diagram. It is possible GAP might ask you the payoff diagram, like provide you the payoff diagram and ask you to find out what strategy is this. Okay, now see, let's start with the covered call. Call is covered. Call is covered. Why call is covered? Because call is generating risk. Why call is generating risk? You must have taken the short position in call and that's why there is a risk. Covered call. Short call plus have one underlying. If you generate loss on the call, you will always have the underlying to protect your position. If you are not generating loss on the call, short call will generate the premiums for you. Simple. Covered call. Diagram will look like this. Okay. In exam, you will see this much only. Please remember. This. Okay. So this is this particular line. A. Will get tested in examination. This is not relevant for your exam. Fine. This is a covered call. Protective put. Here the put is protective. Put is protecting your position. So you own the stocks and you have long put option so that you are able to protect your position. So protective put. Okay. Simple. Remember this. Then we have the spread strategies: bull call spread, bear call spread. First bull call, then we will see the bear call. Bull call position: long call at lower strike price and short call at higher strike price. Long call lower strike price, short call at higher strike price. Aim is to utilize the upward movement of the market. Simple, remember this much. Then aim is to utilize, for the bear call spread, aim is to utilize the downward movement of the market, and positions are taken as long call at higher strike price, short call at lower strike price. Simple. LC high, you can remember like this. Okay, so L long call higher strike price and short call lower strike price. Okay, so simple. Or just remember this visually like this. Okay, so if you remember this visually, bull call spread. So this is the testing area and this is the testing. Bull call, how to remember this? Remember, always remember the cutoff points. Just remember, for bull call, the diagram is like this. So first cutoff is coming from long call, then compensation is coming from short call. Long call at lower strike price, short call at higher strike price. This is how I remember. Okay, if you are comfortable in this, then this is your testing area, like the net payoff or the net profit. Now, first cutoff is coming for, like, it is generating the losses, meaning this must be short call. Then there is a compensation. This must be long call. So what's happening here? Short call at lower strike price, long call at higher strike price. Now the box spread, you can just know the basics. Okay. This is the combination of bull and bear with the same strike price, lower and upper, and the time to maturity. The box spread produces the payoff, which is equal to upper strike price minus lower strike price. What is the upper strike price and the lower strike price? So UX and LX, what is the difference? That will be your payoff. And cost of setting up this strategy is obviously the present value, because the payoff is now defined. So this will be UX minus LX present value. Simple. So here you are generating payoff like this, and here also you are generating payoff like this. Simple. So this is the box spread payoff. This is the bear put. This was the bear put, and this is bull call payoff like this. Okay. And why this is called as a box spread? Because of this nature. And what is the composition here? Composition is like, sorry, this. Okay, I hope you got the idea, and this is how you have to remember. Fine. Then butterfly spread. First, the composition. Just focus on this particular diagram and calculate or find out what is happening here. Always remember, this movement means long call. This means compensation of 1. This means 2 compensation. Compensation comes from the taking opposite position, short position. This means again the second compensation, that is compensation as in the reversal. Okay, now see. We started like this, long call will give like this. If we take this, then this is the 1 long call, 1 short call. 1 long call, 2 short calls. 1 long call, 2 short calls, 1 long call. Okay. 1 long call, 2 short calls, long call, short call but 2. Again, compensation, long call. Lower strike price, higher strike price. So 2 long, we are taking the long call position and long call position in one lower, higher, and in middle we are taking the short call position. Okay, I hope you are able to understand this, like how we are calculating this. And when we will take this position, the long butterfly spread, when to take this position? When the trader is expecting the concentric movement, the central movement. So movement will be around, the underlying price will be around the middle strike price at the maturity. So if this is the scenario, if this is your assumption, then go for the long butterfly. I'll just test you. Like, I know you are not in position to get tested, but still, tell me the composition here. If you are able to tell the composition, you will be able to handle all the strategy questions. Composition. At least try. You will see where you are making mistake.
First is short put, then 2 long calls, one short
Short.
put, no short, one, not short.
Okay. Next, anyone? At least try. This is, I'm giving you the like simplest solution to whole chapter. Then you have to just focus on random diagrams and you will be able to answer each and everything about that particular chapter. What Gap will ask? When to use this strategy? What is the composition? If you know this, like, that's it, finish. And problem is going to happen in the composition. You won't be able to remember or recall like what is the composition. And instead of wasting your 30 minutes on like this composition remembering, just focus here and understand how to solve this, how to understand this flow.
Short put,
First is the short put.
then 2 long put,
Okay.
then composition,
Hmm.
then long put, then short put, sorry.
What is the mistake here? Think about it. And why are we making mistake here?
All cannot be put.
Why? Anup, your answer is close but not correct. Tell me like this: A, B, C. It is better if we invest our time here instead of just trying to remember each and every strategy. Just start from layer by layer. Never read this particular chart from here in this direction. Always read this chart in this direction. First of all, as the price increases, you are generating losses. As the price increases, you are generating losses. This must be
Short call,
correct. There is double compensation because there is cone. This must be
long call,
how many?
Long put,
There is reversal. This must be always remember cone means two, simple stopple. This is the stopping, na? So this is creating a neutral situation. Means one. Okay, so this is the long call or short call. What is this? Correct. Short call. Simple. Short call at lower strike price, short call at higher strike price, and two long calls at medium strike price. This particular strategy is known as a short butterfly. Okay. When we'll use this strategy? When we will use this strategy?
When we expect more fluctuation.
Correct. More fluctuation. Okay. So either on the right side or on the left side, or the upper side or the lower side. Simple. Now I will explain all the strategies in this area only. Just see. Strategy. No, instead of strategy, just tell me composition. Then I will tell you the strategy. Composition. This is how like gap tests. I am not like randomly drawing figures. How to think? I'll just give you the guidance. How to think. This indicates this particular part. This indicates unlimited payoff situation. Right? Simple. Unlimited payoff or unlimited profit situation. As the price increases, this indicates unlimited payoff profit situation as the price decreases. Just decide the strategy, like just decide the composition. Simple.
Long put.
Hmm.
Too long put.
Why too long put?
Like it's going down.
Don't focus here. Don't focus here. Focus here. Just here.
Long call is one long put.
Correct. Long call, long put. So long call will give you this direction. Long call will give you this direction. Long put will give you this direction. Simple. Okay. This strategy is known as a straddle. When we will use this strategy? When to use this strategy?
Hedging.
In case of high volatility.
Correct. Yeah. So higher volatility, extreme movements from the mean. Simple. And again, in straddle, remember, long call and long put at this same strike price. That's why there was like movement from the same direction. Quickly.
One long call, one long put. At a different price. Long call at higher strike.
Long call, long put, but at a different strike price. Okay. So long call at higher strike price, long put at lower strike price. Simple. So if you take this position, again, here our aim is same only. So this particular strategy is known as strangle. Previous one was a straddle. This one. And this is this strangle. Okay. Straddle, strangle. Both have the same objective. Both the strategies are used for the same objective when you are expecting the larger movements. But why are we taking the different, this like the strike price for the long call is higher and short call is lower compared to this strategy? Straddle. Simple. We want to create a cheaper strategy. cheaper strategy. We want to reduce the cost of strategy. So if you want to go, if you have the same objective to earn from the extreme movements, but if you want a lower price of the strategy, then go for the strangle. Why? Simple. Assume for the straddle, this was the graph. What you did, you simply increase the strike price of call option. Automatically call option premium will get reduced. Now lower cost of call means lower price of the strategy. Simple. Okay. Then we have the calendar spread. In calendar spread, composition is you have long call with a long maturity, short call with short maturity. Again, same objective as butterfly, but the composition is this. Here the maturity is different. Okay. And this payoff is slightly different. Okay, this payoff, payoff is like this. Why there is curvature in payoff? Because this curvature is coming from the difference of time to maturity between two options. Okay. Then we have the combination strategy. We already discussed the straddle, strangle, strip and strap. Okay, let's see. Try to guess it. You are seeing like this is more slant and this is more steep. Like there is a reason. Try to guess the strategy. Just visually you can think. One thing is for sure. Yeah, tell me, Nitish, sir. Nitish.
Long call and long put, but
Correct.
speed of second is high. Don't know why.
Speed is high, correct. That is the payoff is higher. So how can you get a higher payoff or more payoff? By adding 2.
Adding 2 times. So
Simple. And then reverse is also there. This is simply long call, long put, but 2 puts. Simple. So this particular strategy is strip. The previous one was strap. Strip and strap. Okay. Strip and strap. Strap is also mentioned here only. Where is strap payoff? Okay, strap payoff is not mentioned here. The strip payoff is only mentioned. Now the exotic option. Okay. So let's start with the exotic option. So exotic option means here we have the variation. Type of questions are very simple. They will provide you specific property of option and you have to guess what type of option is that. Like the barrier option, gap option, then so on. Simple. Okay. So in option we know what are the properties. There is time to maturity. There is underlying price. There is strike price. And yeah, that's it. Now here, if you modify the time to maturity, what can we modify? Simply like there is a deadline, there is a maturity date, and if we say if you can exercise it before, then automatically this becomes an American option. Okay. Now here we can have the variation in S and X. Now the variations are like, instead of taking the value at maturity, S0 is generally tested at maturity, X is tested at maturity, we might say, okay, instead of taking value of S0 at maturity, we will take the average of 3 months. That's now exotic option. Plain vanilla option means this, the basic setup which we know. And exotic means just modify these whatever you like, the way you want. And there is a standardization now, like there are few options or few defined options which have defined properties, but exotic only. Exotic only means, for example, strike price. For strike price, we will take the lowest value in previous 3 months, lowest value of underlying in previous 3 months, and this will become like new type of exotic option. Now we already know call or put in advance. We will say, okay, just buy option, and after 2 months decide if this is a call option or put option. This is the option with the long holder. One more type of exotic option. So this is the world of exotic option. Normal option modified slightly becomes a exotic option. Okay, so let's start with the exotic option discussion. You have to mainly remember here, okay, this is a complete memory game. So we will modify these three features mainly, and in one case the call and the put option. So what are the benefits of exotic option? It offers more efficient hedging, because obviously the requirement might be different for the different traders. So those who think like they have the different requirement and there is an exotic option, and here we are going to check defined exotic options. Defined means there is a proper definition for those exotic options. However, in exotic option you can do anything, literally whatever you want. Like to an extent, like we will assume the underlying price as the average of say the option is on the underlying, which is for the banking sector, the stock on the banking sector, any particular bank. So underlying price will be average of the banking index, like that. You can take this. Okay, so you can modify, like you can do anything. Okay, but here we will use only the defined options. Ability to limit the exposure or increase the exposure. You can increase the exposure or limit the exposure, and can also use for the tax or the regulatory purposes not discussed in the curriculum. Just a basic definition is provided here. Okay, now first of all, let's see the zero cost products. Zero cost product means you are buying one call option, but you want a zero cost, like you don't want to pay anything today. So what we can do, there is an option, there is a possibility in the option, the premium with added interest will be paid in the end. Generally at time T0 you will pay premium, at time T1 you will get payoff. So here how it works, simple, the payoff minus C0 into e to the power RT, that is after loading interest, and this is your payoff. Instead of paying today, you will pay it at the end, but you have to pay. Okay, in option you have to pay. So this is now the zero cost. So right now you don't have to pay anything, so this becomes a zero cost product. This is also known as a future style option. Okay, so next, the exotic variation of the American option. So American option can be traded any time before the maturity. It can be exercised any time before the maturity. So exotic variation of the American option is created by putting a restriction on the early exercise. Okay, now exotic option of the American option, exotic variation of the American option, how it works? Okay, so you can exercise it anytime, but okay, now the restriction is options maturity or duration is say for 6 months. So for first 3 months you cannot exercise it. After 3 months you can exercise it. This is the one variation. Or first 3 months you cannot exercise it. First 3 months you can exercise it, but after that you won't be able to exercise it. So this is again the variation. Ideally this is the time T0, this is the time to maturity, and if this is the American option, say CA, then in this particular case you can exercise this option anytime. We might say, okay, so for first year, no exercise or exercise. This is the one situation. Or we can say exercise in this period, don't exercise in this period. Now we are creating an exotic option. Simple. Now, valuation is always a problem for the exotic option. And for the American option, you can use the binomial option pricing. Okay. And for the binomial, if you use the binomial option pricing, then for a certain period it will behave like a European, after some point it will behave like an American option, and so on. So this is how the binomial option works for the American option. Now the exotic option, the forward start option. Forward start option means you will purchase option, just a second, just read it out. Option which begins at the future time. So employee stock option. Okay, so ESOP is an example of forward start option. Forward start options are at the money at the time it starts. Okay, so click option is there. So there is a series of forward start options. This is chain of forward start option with the rules to determine the strike price. Assuming the click it option with two options, one starting at the end of the 1 year and another starting at the end of the 2 years. Both the options are with a 1 year maturity. The strike price rule can be the strike price of the option is equal to the underlying price at the start of the option. Whatever is the start of the option, that will become the strike price. It can be there are possible variations even in this. For example, there are two options. Okay, so this is the expiry of first option, option 1, and this is the expiry of option 2. The variation can be, so for option 2, the strike price is equal to whatever is the underlying price for, or which was used for the option 1 at the expiry, like this. This is the meaning of the statement. Okay, then we have the gap option. Now gap option have very different property. This is our general payoff. Normally this is how it works. There is a strike price. If the underlying price is above, this is for the call European. If the underlying price is above the strike price, automatically you will generate a payoff. Now here, instead of one strike price, we will have two strike price. Okay, one is known as the strike price and another is known as the target. Now the payoff is still equal to, say, x minus s only. Payoff is equal to x minus s only, but you won't get any payoff till you hit the target, and directly your payoff will go like this. Normally it would have gone like it would have started like this. Okay, so here your payoff will be like this. So for this particular period you won't get any payoff. If I have to give the example, numerical example, currently underlying is trading at $100, strike price is $120 and target is 140. Now here, if the underlying is equal to, for example, say 130 is 130, then in this particular case your option is exercisable, but you won't get any payoff because it's the exotic option and target is not yet reached. If you have underlying equal to 140, then target is reached, you will get the payoff is equal to 140 minus 120. Okay, and if the underlying price is equal to 150, then again target is reached, so you have to cross this 140 to get the payoff. But remember, the payoff will be calculated based on the basic rule only, so x minus s or s minus x only. Okay, so that's how it works. So here we have the call option. Again, these are the illustrations for the call option, and there is a typical situation because the formula for the calculation of payoff is very well defined here. This is s minus x for call option. Okay, now the payoff will be there. Payoff is must if the target is reached. As soon as the target is reached, this s minus x principle will be applicable. S minus x will trigger. Now see what happens. Assume your underlying price is equal to 140, target is 130 and x is equal to 150. S0 140, target 130, x 150. So first, as soon as underlying reaches the trigger, there will be payoff. Underlying reached the trigger, underlying is above the trigger, there will be payoff, and payoff is calculated as s minus x because it's a call. Currently s is 140, x is 150, so total payoff is 10 minus and in this particular case long will generate negative payoff. And this is what you need to remember in examination, that in case of the gap option, if the target is below the strike price in case of call option, and if the target is above the strike price in case of the put option, then the long option holder will generate a negative payoff, which is not possible in the normal plain vanilla option. Okay, so long holder will always get a positive payoff, right? Then we have the chooser option. Chooser option as in the option starts after a certain point, you have to decide if this is the call or the put option. Whether the option is call or the put option. Chooser option. At the beginning, option is neutral, neither call, neither put. Binary option. So binary option is proper betting. Okay, you will get cash or nothing. If you win, you will get 50. If you lose, nothing. So underlying price is 100. Strike price is say 90. This is call, binary type. $50 is payoff. Now $50 is fixed. Under normal circumstances, you would have got $10 as payoff, but here you will get 50. So anything, if your underlying is above 90 at the expiration, you will get 50 fixed. That's it. Now here, if your underlying is even like 200 or 300, still you will get 50 only. Nothing more than that. So fixed payoff option. So here there are two possibilities. One, cash or nothing, or asset or nothing. So you may get a asset is applicable only for the dollars or the currencies. So you may get a currency, or you may get a cash or nothing, cash for that. Simple. Then we have the Asian option. In Asian option, the variation is simple. Either it can be arithmetic average of the underlying prices during the life of the option, or it can be the average of, just a second. The average price is usually calculated using the end of the day price. Okay, and hence the payoff of the option is average price of the option is equal to call is equal to average S0 minus X or 0, same formula. Or there is another variation of the option. Your strike price X, this X is calculated, the strike price of the payoff in the payoff is replaced by average of the stock option. So your strike price can be changed into the average. Instead of S0's average, we will take the strike price as the average. Just remember, the Asian option has to do something with the average, because in exam question will have this information. Okay, this is the average, and like the previous average of underlying in the life of the option. This type of statement you will see. This means the Asian option. Then we have the look back option. We have floating look back call, floating look back put, fixed look back call, and fixed look back put. Okay, so 1, 2, 3, 4. So here look back means we will look for the previous values, and values goes like, it replaces the floating look back replaces the strike price, fixed look back replaces the underlying price. First you need to remember this, floating look back will replace strike price, and fixed look back will replace underlying price. Now what we will replace? Our payoff formula is same. If this is the call option, so asset price at the maturity, max of payoff will be equal to max of asset price at the maturity minus, we are replacing strike price here. So strike price is minimum price of asset in the life of the option. So instead of starting with the X as a fixed, we will decide X at the maturity, like whatever is the minimum price of the asset in the life of option. Then this also replaces the strike price only, but here we will take the maximum. X is maximum here. Why so? Because in call option, payoff will be generated as S minus X. So if your X, if you decide like, no, we will take X as maximum, then the call holder will never generate a payoff, right? Simple. On the other hand, in case of put, if you take the strike price as minimum price in the life of the option, again, there is a least likely like the long will generate the payoff, right? So for this reason, here you have the maximum price, here you have the minimum price. Now X is replaced. Okay, then fixed look back. So here it replaces the underlying price. Remember, objective is to give the long or the long position holder maximum payoff. If you want to give the long position holder maximum payoff and you have to replace say underlying price, what you will do? Maximum underlying price in the life of the option. Maximum price in the underlying. Okay, minus X. Here X is fixed. And then floating look back put option. Maximum advantage should be passed to the long holder. So for long put, minimum underlying price. Okay. Then we have the barrier option. Barrier options are very easy. Down and out, down and in, up and out, up and in. Down and out, down and in, up and out, up and in. So down and out. The price goes to, like, price goes below a certain threshold. If it goes below, then option is out. Irrespective of what happens at the maturity, it doesn't matter. Option will expire automatically. Remember, it is expiring, not exercising. Expired. Down and in. Unless option's underlying price goes below a target value, a certain target, it will never activate. Okay. So like this, if this is the target. So option is like underlying price is going like this, and like this, and this is the expiration date. So this, irrespective of what happens, this option was never activated itself. So this option is a down and in. So it should have touched this particular barrier. If this goes down and in, then it will be in. In stands for the activation. Okay, activation or expiration. Up and out, up and down stands for like it should go below the target or above the target. Same we have up and out. So up, it goes above that, above certain level, it is out, finish. Then up and in. If it goes to above certain limit, then it will be in, activated. Simple. Then compound option. Compound option is the simplest. Text is like, lot of text is available here. You don't have to bother about the text. This is the call on call option, call on put option, put on call option, and put on put option. Simple. Don't bother about this naming culture, naming convention, the call and call, put and put, call and put, put on call and everything. Don't bother about it. Simple. Call on, instead of like, think about call, that's fine, but call on any underlying asset. Whatever you do with that particular underlying, you will do with this call. That's it. Okay. So simple. Call on. Here you have your underlying only. So call's price changes like any stock price. So call's price will change. Based on that, your call price will change. Simple. If you have put, your put price will change. Depending on your call price will change if you have call on put. Okay. Difference between call on option and put on option. Just basic. Now, asset exchange option. So here, if you are able to exercise the option, your asset will be exchanged. Simple. Basket option. Combination of option. You will create you will pull multiple options, and this will be the basket options. Again, testable area is this only. The basket option is simply the basket of option. Exotics on volatility. So first of all, we have the volatility swap and the variance swap. Simple. Volatility swaps formula is realized volatility minus pre-specified volatility. For a particular period, we decided like the volatility will be 10%, we enter into volatility swap. I am fixed payer. I am going to pay you fixed. Meaning I will receive whatever is realized. Say realized is 12%. I am paying fixed 10%, I am receiving 12%, and notional was say 1 lakh. Simple. This will be the payoff. Okay. A, that is the notional value. Realized volatility minus pre-specified volatility. That is a fixed volatility. That is which was defined in our contract. Simple and calculated, and this will be the payoff. And whatever like you are paying or receiving depends on your position. Variance swap. Instead of volatility, instead of sigma, let's take sigma square. Okay. So the problem is like the investment bankers or the people who are working in the industry gets bored of doing same thing again and again. So that's why they create all such variations. Now hedging using the exotic option. Always remember, hedging using the exotic option is always better compared to or always beneficial compared to the standard plain vanilla option. So compared to plain vanilla option, exotic options may be easier or difficult to hedge depending on the type of exotic option. Obviously, you will select the option which is easier to hedge, which will create a comfort in hedging or which will create a ease in hedging. So exotics like the Asian options are easier to hedge than the vanilla option because the low sensitivity to asset prices. On the other hand, almost exotics with the discontinuous payoff like the barrier options are difficult to hedge because the sudden movement in exercisability of the option. To deal with the complicated exotic hedging, the traders develop a procedure called a static option replication. The principle is if the two portfolios are worth the same or the same boundary must also worth the same at all interior points. It's like on the broader level, if the payoff is same, so inner level also it should generate the same payoff like that, the same value. It should have the same value. Hence, if one can find that a plain vanilla option which is worth the same as an exotic option on the boundary, the exotic option can be hedged by shorting the portfolio. Okay, so again, if possible, remember, otherwise leave it. General testable area is like the barrier option, what is the composition of the option and everything like that. Okay, so this is the end of our 12 chapters revision in one session. I guess we covered all 12 chapters, right? Okay, so thank you and thank you for joining today's session. I will update you on tomorrow's session. Okay, so we have to again check for the availability of other students and just inform me your exam dates. Just a second.